updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Rally in big technology stocks pushing the major averages higher right now. Now, at the same time, you have the latest data that seems to suggest the Fed may have to raise interest rates higher again. The Conference Board, among others, reporting its U.S. Consumer Confidence Index advancing this month, posting the strongest showing since January of 2022. Jack Ablin, the Chief Investment Officer at Crescent Capital, says stocks may have come too far too fast, though.
We have projected the S&P to be up between 5 and 7% this year. We're up, nearly 14. So I think that there will be some sort of a reversal, particularly when you look at the spread between S&P cap weight and S&P equal weight.
Now, among the most active, Walgreen Boots Alliance, that's down close to 10%. They slashed their earnings forecast. Right now, the S&P 500, 18 points higher. That's up 0.4%. We're at 43.47 on the index. The Dow Jones Industrial Average up 125 points. The NASDAQ 100, 81 points higher. That is up 0.6%. I got to leave you with this. Median intern pay jumping 19% at top Wall Street. You know what their weekly pay is? These are the interns. $4,400.
What?
A week.
Oh a week?
I could be your intern. Jess, how do you like your coffee?
Exactly. I tell you, it still pays to work on Wall Street.
Wow.
You got to be kidding me.
That's mind-boggling.
Yeah, that is your Bloomberg Business Flash, Jess and Paul.
John Tucker, thank you so much. We
No
appreciate
words.
it. No words, exactly. We'll just move on. One of the numbers that always sticks out of me is when we look at the JOLTS number, the job openings.
Yes.
That's a number that historically ran 5-6 million job openings, but it's been close to 10.
Right, consistently.
I'm like, where did all these people go during the pandemic? And one issue that comes up is there's some ages. Maybe some people are kind of aging out of the workforce, but I want to get a sense of kind of, what ageism means in the labor market and for the economy. And our next guest did a lot of work on that. Michaela Grimm, senior economist for Allianz, joins us via Zoom. So, Michaela, talk to us about kind of what your work showed as it relates to ageism in the workforce. Are people just simply aging out of the workforce?
What we saw, especially when we looked at the pension systems, where we see the need that people should work longer or should stay longer in the working age population to cushion the demographic effect on the pension systems, but on the labor markets as well, is that when politicians propose the increase of the retirement age, it's often answered with protests like we saw in France, because people are afraid that they don't find a job in higher ages, and that any increase in retirement age just means longer unemployment before retirement, and in the end, a kind of a hidden pension cut. And these fears are not out of the blue, because we see that in higher ages, the chances to be unemployed for longer are higher. The long-term unemployment rates of the age groups 55 plus are much higher than in the average workforce population between 25 and 54, for example. And if older workers apply for a new job, they are often facing stereotypes about older workers. And given these environment, many people who get unemployed after the age of 55 either drop out of the labor force or decide to go into early retirement.
How does this differentiate when you're looking on particular regions and countries, say the US versus Europe?
In the US, we see a lower rate of longer unemployment in higher ages, and it's already a little bit higher, the activity ratio, than in the EU, for example. And we see also that in countries where the retirement ages are already higher, like in Sweden, for example, or in Singapore, we see much higher activity ratios among the older workforce population.
So, Michaela, I guess I was surprised when I saw the incredible public uprising in France when they were talking about raising the retirement age. I think it was from 62 to 64. It didn't seem like that big a deal to me. Maybe that's just a U.S. bias. Did that surprise you, or is that consistent with some of the data you've seen?
Well, from the German point of view, we were surprised as well because our government agreed to increase the retirement age to 67 already. But we see also that in France, the unemployment ratio of older workers is higher than in Germany, for example. And therefore, there was the concern, for example, that if the government pushes the retirement age to 64, it just would mean a higher rate of or longer term of unemployment before retiring in the end. We saw that in surveys that this was one big concern of the working age population.
When we're looking at the U.S. specifically, what's been the main catalyst that's keeping older workers out of the workforce longer, and how much did the pandemic end up exacerbating this?
We saw in surveys as well that many older workers decided to retire early. But we also see in surveys from RRP that they face age discrimination, that there's, for example, a wish to participate more in training measures, that there is a wish to have more flexible working hours, to be able to choose where to work, to have more the chance to work from home, to work remotely. And still, I think companies, or many companies, that is not only in the US, as we did not face the impact of demographic change until recently. And it paused, for example, in many countries, and now baby boomers start to retire. Now companies feel more the pressure to adapt to the needs of an aging workforce population. That was not the case in recent years. Therefore, I think since many workers still face age discrimination, the step to say, okay, I drop out or take a lower paid job, or even I have to take a lower paid job that does not fit to my qualifications, then early retirement is an option.
What subsidies or what support, I guess, can governments provide companies to maybe, hire more older workers? Is there a role that governments can play in this?
Well, we see in some countries there are already kind of advertising campaigns in place, like in Singapore, where the government tries to push for a cultural change, for change of the perception of older workers. But what governments can also do, as we see a need for reskilling, for upskilling, for lifelong learning, it's especially smaller companies who often cannot afford, for example, these kind of measures. So it would be one measure to support companies when offering trainings for their workers. It could be also possible to support subsidy or grant subsidies when employing older workers coming from long-term unemployment. It would also be a measure to support part-time employment. It could be a measure to say, okay, we reduce contribution rates or taxes for workers after a specific age.
Yep.
Then other measures could be, when we look at the pension systems, to make it possible to combine work and retirement, part-time retirement, or as I said, to get away from the mandatory retirement age, make retirement ages more flexible, and for example, grant the right to work.
Yep. All right, all interesting stuff there. Companies, countries, politicians have to think about this as the global population continues to age, and you have that mismatch, and it's really pronounced in certain countries. Fewer newer workers coming in to support the older workers, a big problem. Michaela Grimm, senior economist for Allianz, thanks so much for joining us. And I think I probably speak for John Tucker when I say I'm going to be working a lot longer. I mean, I don't see that.
What's the retirement age in France again?
It's now 64. Are you thinking about a little relocation?
Yeah.
from the Jersey Shore.
That
over to
intern pay we were talking about.
Exactly. John Tucker, our up-and-coming intern, if anybody's looking for one. All right, we'll have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Suspended 2 more funds, including its flagship fund, after a flood of redemption requests from investors. It's the latest fallout following multiple sexual assault allegations against founder Christian Odie. Bloomberg financial editor Michael Moore reports.
In some ways, it's not a surprise because Crispin Odie was the main portfolio manager on this fund. You have to imagine that fund has shrunk in recent years. Those who had held on seem to be believers in Crispin. So now that he's gone, you kind of lose that superstar who was running that fund. So both funds that we're seeing today, the flagship and the other one who were suspended, were both had Crispin Odie as a portfolio manager. We've also seen other funds that he didn't run also have to be suspended because of the redemption request.
Thanks, Michael. Walgreens stock fell the most since late 2020 after the drugstore chain slashed its fiscal year earnings forecast. The company says a drop in pandemic demand and a slow transition deeper into healthcare were factors. And Paul, do you remember how healthcare companies reported an increase in people's services recently?
Sure.
Yeah, well, you know what's behind it?
What?
Well, according to a UBS analysis, pickleball injuries.
Oh.
Yeah, the firm estimates that pickleball injuries will cost Americans up to $500 million this year. UBS looked at the data and found that the majority of injuries occurring among players age 60 or older, and that could explain why insurance companies are reporting a rise in procedures such as hip and knee surgeries. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Jess Mint and Paul Sweeney here in the Bloomberg Interactive Brokers studio. Got a strengthening tape this morning. Got the S&P 500 up about 0.5%, NASDAQ up 0.6%, so some good movement on the back of some stronger than expected economic data across the board we saw this morning. Also want to call out the yields slightly higher, 10-year Treasury yielding 3.76%. On the commodities front, WTI crude oil off just a little bit, sitting right at $69 per barrel. So we keep an eye on Brent crude and WTI crude as well. Gold a little bit lower here, $1,918 per ounce for the bullion. Right now, let's head down to Washington, D.C. We get world and national news with Nathan Hager.
Well, the Supreme Court has ruled that North Carolina's top court did not overstep its authority when it struck down a congressional redistricting map as gerrymandered. In a 6-3 decision, the justices rejected what is known as the independent state legislature theory. This is the idea that state lawmakers have near total authority to set the rules for federal elections. Writing for the High Court, Chief Justice John Roberts said state courts retain authority to apply state constitutional restraints, and federal courts must not abandon their own duty of judicial review. Russian President Vladimir Putin says his military averted civil war with a deal to end the Wagner Group's armed rebellion. Putin led a Kremlin ceremony with about 2,500 troops today as Wagner leader Yevgeny Prigozhin arrived in Belarus, and Russia's Federal Security Service closed its criminal investigation into the mercenary group. President Biden says it's still too soon to draw conclusions about the revolt, but he says the U.S. and NATO played no role in it. Julie Norman with University College London Center on U.S. Politics says that's the right move for the president.
Biden very quickly on Saturday immediately made contact with Moscow and said, this is an internal affair. We're not having anything to do with this. This isn't an outside job. And they've been publicizing that communication since.
Julie Norman at UCL says that could head off any conspiracy theories, including from Putin himself. The Justice Department's internal watchdog is faulting New York State prison staff over Jeffrey Epstein's jailhouse death. A report out just this morning from DOJ's Inspector General says it didn't find any evidence to contradict the FBI's conclusion that Epstein hanged himself in his cell. It says a combination of negligence, misconduct, and outright job performance failures gave one of the most notorious inmates in New York State history the opportunity to take his own life. Former President Donald Trump and Florida Governor Ron DeSantis are holding dueling campaign events today in New Hampshire. The governor is holding a town hall in Hollis, while the former president and current GOP frontrunner is speaking later at a lunch in Concord hosted by a Republican women's club. That group put out a statement last week criticizing DeSantis for scheduling his event 40 miles away and a couple hours before their event. Global news, 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager in Washington. This is Bloomberg. Paul and Jess.
All right, Nathan Hager, thanks so much. We appreciate that. Jess Mint and Paul Sweeney here in the Bloomberg Interactive Broker Studio. All right, Jess, you got a minute and a half, go.
I know on all these fills, I end up talking about the columns that I've written for
you're very busy, I'll give you that. And some good stuff is
I have a day job, but I'm not here with you, Paul. So I did today's Taking Stock column. I was looking at how a key market model turned bullish after flashing red. And this is just for you, Paul, because it is Bloomberg intelligence data.
Oh, nice.
So I know that was going to get your attention.
Boom.
So this is Gina Martin, Adam's team, Jillian Wolf also on this. So they were looking at their model. It's the Market Regime Index. So basically, this is clustered into 3 different periods where you have red, yellow, green. We were in the red phase of this for about 15 straight months, just moved over to yellow. The reason this matters, it means it's more moderate growth when you're looking at the equity market. So it has about 6 different signals in this, and all of them have improved when you're looking at how, say, intercorrelation with stocks and things like that. The one thing that hasn't improved just yet is corporate bond spreads, but this is basically indicating historically that this would be more favorable rewards when you're looking at the stock market to the next 6 to 12 months. Obviously, you'd want to see that more in the green, but this is a phase where it's looking a little bit more bullish.
Yeah, and I love her research because she does have this nice little colorful things in red and green, and I can understand that. And so I know when to buy stocks and when not to. And oh, by the way, this is great reporting by Jess Mint, so we appreciate that. More coming up.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to check in on those markets again. A strong day, getting a little bit stronger. We'll check in on that. Fernando Valle, he's a senior analyst with Bloomberg Intelligence. He is our global energy guy. I want to get a sense of where global oil prices are going. I know it's a supply and demand thing, but it feels like demand and weakening demand is kind of winning the day here. Plus, we're going to check in with George Ball, chairman at Sanders Morris Harris, and get his market call. But first, let's go to the intern, John Tucker. He is in our Bloomberg Interactive Brokers studio, the well-paid intern.
No, I'm still looking at these figures. A standard month with a 40-hour week at Citadel Securities, $19,200
a month.
Yeah. I didn't get paid anything when I was.
Wow.
Just got abused when I was an intern. Anyway, major averages, they are higher, but off the best levels of the session right now. That is going to become because of Treasury yields. They're rising after that better than expected economic data that we saw earlier today. Among other things, you had durable goods orders. They continue strong growth. Consumer confidence, that's higher. New home sales, that surge. This all suggests the Fed may have to hike interest rates again. Still, James Camp at Eagle Asset Management among those forecasting a recession in the U.S.
It's a slowing economy, and I think the Federal Reserve has basically told us the only way out of the inflation conundrum is to have a recession, and I think we should take them at their word that they're going to continue to push on short-term interest rates, and there will be some follow-on effects with longer-term interest rates to get this economy to slow down.
In the S&P 500, you have consumer discretionary, materials, information technology among the best performing industry sectors right now. Among some of the individual shares, Meta Platforms, that rose. Citigroup analysts lifting their target there. You have Alphabet. That is falling right now, and analysts said it was moving too fast in artificial intelligence. S&P 500 right now, 19 points higher. That's up 0.5% at 43.48. Dow Jones Industrial Average is up 127 points. That's up 0.4%. The Nasdaq 100, 74 points higher. That's up 0.5%. Let's do yields too. Two-year yield right now, 6 basis points higher, 4.74. The 10-year, 4 basis points higher. That's at 3.76. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg business. So it was 40 years ago that I was an intern.
Really?
Amazing.
For over 40 years.
In radio?
I don't even remember. No, you know what I was doing? It was a job in college. I was, you know, the banner planes, the planes that tow the
Jersey
banners.
Shore, you bet.
At the church. I was putting those together.
Really?
At the airport.
That would be fun.
That
it was
sounds
the worst
great.
job
No?
I've ever had in my. It was awful.
I think I want to be a pilot for one of those planes. That'd be fun.
And then you decided radio.
I need to say,
You got to get out of that.
and the world's a better place for it.
All right, JT, thank you so much. Always a pleasure. Well, Paul, we have a star reporter on our equities team that are joining us here. For the first time, Alex Simonova. She covers all things strategy. You and I were talking about Mike Wilson earlier. She can walk us through all sorts of different calls on Wall Street beyond even just what Morgan Stanley is saying. But Alex, what are you taking a look at today?
Thank you so much for that very nice intro, Jess. That was kind of you. I'm so happy to be on here with you guys. The first name that I want to mention today, because it is such a bellwether for technology growth stocks, is Tesla. Shares are rebounding today after the stock plunged more than 6% yesterday following a downgrade from Goldman Sachs to neutral from buy. It, of course, joined a wave of other brokers in turning less bullish on the electric vehicle giant. This comes after, the red-hot rally that we've seen for Tesla shares this year, along with other technology names. Remember, just recently from the end of May through the beginning of June, Tesla notched its its longest ever winning streak, rising for 13 straight sessions. So Wall Street analysts have been warning recently that this quick rise for the stock is starting to show signs of unraveling. Many folks have been concerned that investors have become way too optimistic on its autonomous vehicle ambitions and the scope of the AI race, and also saying that the stock is starting to look overbought. And this is kind of symbolic of this bigger bull versus bear debate that we're seeing on Wall Street, where some strategists are getting a little bit more optimistic on what the rest of the year will look like, raising their price targets, getting bullish on AI, while some of the permanent bears are kind of digging in their heels and saying that we're due for a leg lower.
Right, and you cover so much with this different strategy calls. So Savita Subramanian over at Bank of America, Alex was all on top of this when she started raising her target actually to 4,300 from about 4,000. What else have you seen when it comes to some of these strategists that are slowly getting more bullish now?
Yeah, I mean, it's been such an interesting divergence. We had SocGen last week also lift its target, saying that it sees the momentum from AI continuing into the second half of the year, but pushing out its recession forecast to the first half of 2024. So it's also calling for that leg lower, but saying that we will see the momentum kind of extend through the rest of 2023. And then you have interesting takes like ones for like the one from Citigroup, which did admit that it missed out on the opportunity to grip mega caps with this AI euphoria, but it is not going to budge on its target. We got David Kostin at Goldman Sachs also raising his target, but then you have names like Mike Wilson at Morgan Stanley, Marko Kolanovic at JP Morgan, who continue to say that they just don't see fundamental reasons for this rally, that they're concerned about growth, about a potential economic downturn. They're raising concerns about breadth, kind of talking about how it's only tech driving this market higher.
So what are some of the, I mean, it's interesting here. Are we concerned that we're not seeing more breadth in the market? As so many people have called out, boy, if you don't own the big names like an Apple or, you know, a Meta, you really haven't participated so much this year in a rally. Are strategists concerned about that?
Yeah, I mean, again, also seeing mixed reactions on that. Savita Subramanian at Bank of America, for example, is saying that concerns about bad breath are overblown, that we're likely to see the rest of the names catch up. She spoke about mean reversion, even saying that the equal-weighted S&P 500 could yield double the returns of the S&P 500, and that we could see a turn where some of these laggards are going to start to catch up to tech. So a bit mixed there when it comes to breadth. You know, you can make an argument for both sides. People always say that there's something for the bulls and something for the bears in this market, and that really seems to be the case across Wall Street.
I know you were talking about seasonality too, about how gangbusters July usually is, but because of a strong first half to the year, might not necessarily be the case because of these gains that we've seen. I think Jonathan Krinsky over at BTIG was taking a look at some of that data.
Yeah, exactly, Jess. July is really going to be a big make or break moment for sentiment because we were expecting the June swoon and it didn't quite happen. Stocks have been losing momentum in recent trading sessions, and now investors are looking ahead to July, which is seasonally very strong for technology stocks, but some are pointing out that we might not see the same kind of momentum in July. So we'll have to wait to see. I think that'll be very telling for investors who kind of want to join in, want to kind of move their cash off the sidelines to see whether they will put it into these technology names.
How much cash is on the sidelines? That always seems to be an argument.
The money market funds. We just saw in the latest week, the flows, their second consecutive week of outflows, but that was since obviously we saw a big outflow in the middle of April because of tax day. But if you continue to see that trend happening, that could be more of the money
presumably
coming out of
that
the
money's
market.
going into stocks and bonds? And
Some of that is, right. But can that trend continue would be the key thing there.
Okay.
Jess is the expert there. She's been doing terrific reporting there. But I was going to add to Jess's point and say I spoke to a portfolio manager at Morgan Stanley who says that we could really see the cash coming off the sidelines after the summer months in the fall, when if the rally continues and everyone is sitting on cash and their clients start asking them why they're not seeing the returns
missing out on these double-digit rallies.
The FOMO is really going to start to kick in the fall.
Yeah, that's a great point. I mean, if you're not owning the right stocks here as a portfolio manager, you're trailing.
Right.
And now, do I have to spend the second half of the year trying to catch up?
After the S&P hit a low last October?
Yes, that's been a heck of a rally. All right, Alex, thank you so much for joining us. Appreciate it. Hope to see you
She'll be back.
more.
I'm slowly infiltrating with my
definitely.
team.
Yeah, that sounds good. Alexander Semenova, Bloomberg Equities reporter, joining us live here in the Bloomberg Interactive Broker Studio. We appreciate getting some of her thoughts. We're going to talk about oil at some point as soon as we get Fernando Valle. But I'm just looking at crude oil here. Under $69 a barrel, it just feels like all that's going on geopolitically, it should be higher. But again, when you look at these commodities, you have to have a supply model. Where's the supply coming from and how much is coming in? You have to have the demand model. How many barrels per day is the world going to need? And you kind of mix that up and you kind of say, well, I got greater demand versus supply or vice versa.
Yeah.
And that's kind of the driver here.
Looking at U.S. oil prices trading below $70 a barrel, right close to 69 right now. And I feel like whenever we talk to Miami Mike McGlone over at Bloomberg Intelligence, he's always digging us into what's happening when it comes to crude prices and that threshold there. But looking at that this morning, Paul, a bit below that psychologically important threshold for crude oil.
Yep, interesting stuff here. So when you want to talk global demand, global supply of the stuff that they bring out of the ground, you got to go to Fernando Valle. He covers all the global energy stuff for Bloomberg Intelligence. He's been doing it for years. Very well known on Wall Street, and appreciate getting a couple minutes of his time here in our Bloomberg Interactive Broker studio. So Fernando, I mean, should I be surprised that WTI is at $69 a barrel? I mean, it feels like it should be higher. McGlone says it's going lower. I don't know.
I mean, we've talked about it, and it's the one time me and Mike are in total agreement. We're going lower, at least in the short term, and you see even the traders acquiescing to that view now. If you look at the CFTC futures, they're really moving towards our view that the recovery in oil demand is not slated for the second half of the year.
Okay.
You can't fight the Fed.
Yep. So Fed raising rates, slowing the economy down, we need less oil.
We need less oil. I mean, it's not just the Fed at the end of the day. It's also the Bank of England. It's also the Bank of Japan. All of those are contributing to a lot lower demand. And, you can't have a recession in Europe and the U.S. without impacting Chinese exports. And that's what we're finding out, is that reopening in China is also going to be lesser than, because we are ultimately their end consumers.
And that's what I was going to ask you, as far as when it came to those bets about China's reopening and how that can correlate with the stimulus and what that could mean for the demand when we're looking particularly at oil and crude prices. What do you think would be the next catalyst moving forward, and what particular thresholds are you watching if you're, say it's U.S. crude prices or Brent in particular, as far as make or break? Because we were just talking about that $70 level for particularly U.S. oil prices.
Yeah, I think 50 is probably, it's a nice round figure, and that's where you tend to look for some support. There's an emotional level at 50.
Right.
And if you look at even at a lot of the companies I cover, the Exxon's, Chevrons, and even their European counterparts, they set their dividend levels at 50 to 55, saying this is defensible. Some of them can go lower, Exxon and Chevron in particular, and ConocoPhillips. They can go lower, but that tends to be an emotional support. I think the other portion that you look at is it's OPEC and it's Saudi Arabia. They've already cut. They have a much higher fiscal break even, so not their production level, but what they need to make sure that they can pay all their bills and all their subsidies. And they're already struggling. But the issue is, a lot of the bull case before was we'd have no spare capacity. And what did Saudi just give you? Lots of spare capacity.
How did they do that again?
Well, they cut production.
Oh, they cut production.
So
okay.
They cut production, but they left spare capacity. So you can always bring back that production. You didn't permanently shut in the Guar field, so you really still have it.
Where's China? I thought China was a big demand driver. Where are they in this whole equation?
Well, they, even for their own expectations, have been underwhelming, and you've seen that from all the talks from Xi about stimulating the economy. And the issue is the Chinese consumer is also stretched. And then, as I mentioned earlier, if we're not consuming, we are their main export markets. That has a reverberating effect on their exports, their production, and their use of oil. And then they had built a significant stockpile on crude specifically. They were over 1 billion barrels in total crude stocks, potentially 1.2. The data is a little murky. That's a lot of crude. You can go through it very significantly. That's several months of supply and destock before you actually need to impact the crude. And they are not dumb. They'll use that to wait off if the prices are high.
Does China produce any crude, or are they just complete net importer?
They are a net importer, but they produce around 3 million barrels. It used to be closer to 4 pre-pandemic, and then that had a.
I think of China. You just think of China, how huge that is. There's got to be oil under there somewhere, right? There
is, and there's a lot of natural gas on the eastern shores as well, in the southeast China Sea. CNOOC is a big player, so is PetroChina, CNPC.
But don't they view it as a a weakness, a tactical weakness of being a net importer? Particularly when we have become a net exporter, the U.S.
Absolutely, but there's a limitation. They are closer to 18 million barrels, so from 3 to 18, you just look at how long it took us to find that, and they don't have the technology to do shale. They're also much bigger in coal. Geologically, not to bore you, that is a different stage in the hydrocarbon
Interesting
scale.
How does the slump when it comes to Russia's crude shipments end up playing into all of this?
Well, they're actually, the slump is really on the official numbers. And the extra official numbers, they're still selling a lot of crude to China, India, Pakistan, and that's been one of the issues that OPEC has tried to solve. So far, not so successfully. The question now is, with this new quota and this new agreement with OPEC plus being Russia, will they actually respond to that and cut as they were supposed to? There were a lot of talks of a rift between Saudi Arabia and Russia because Russia hasn't really made good with their expectations.
And what do you think the trajectory, when we're looking at crude prices in particular, tell us about the direction of the global economy?
Well, I think it's not a pretty picture. And again, we look at the logistics side of the equation in the U.S., 3 months of straight all-time lows. We look at real estate being an issue. The housing starts were good, but that was probably just a temporary jump. But if you look, the first declines in home prices in 11 years in the U.S. just posted now. So all of that is a huge concern for crude consumption. Remember, construction season is really what drives the summer bump in gasoline consumption. So if we don't have that, that's a huge concern for oil prices, and then that's obviously a bad sign for the economy.
Well, John Tucker's driving back and forth to the Jersey Shore every day. He's got to be a driver of gasoline.
344 at the. I went to the Quick Check this morning at
Route 36,
just before 3 a.m.
Okay.
By the way, just parenthetically, the people who work at the Quick Check overnight at that particular store, they swear it's haunted. So,
really,
I mean, if you're into that sort of thing,
stop
the haunted
by.
Quick Check in New Jersey, where gas is $3.44 a gallon.
I went to college in Colonial Williamsburg. We're all about the haunting. But not haunted is you paid about $21 less to fill up your tank versus this time last year. So.
See, there you go.
Wow.
So we think, Fernando's an okay analyst, but when we need the gasoline check, we go to John Tucker. Fernando Valle, I know you're well known on Wall Street, but we've got our own guy here. Fernando Valle, he covers all things energy for Bloomberg Intelligence. We didn't get to nat gas. That's like an all-time low. It's tough to be in the nat gas business. But Fernando Valle, he joins us here in our Bloomberg Interactive Broker studio. And again, WTI crude oil just sitting right under $69 per barrel. It feels like it could be higher, but again, a lot of folks are saying it could be lower. So we will stay on top of it.
Year-to-date change down 13%.
Yep, good point there. Good point. S&P, we are up 0.5%. So we will also keep an eye on that. Yields up a little bit higher. 10-year Treasury 3.77%. We'll have more coming up. This is Bloomberg. All right, let's get some company news right now with Steve Rappaport.
Paul, it looks like the pandemic demand bubble has burst for Walgreens, with shares falling to their lowest level since late 2020. Let's get more on that from Bloomberg's Abigail Doolittle.
The range is now $4 to $4.05, from $4.45 to $4.65. The company seeing dramatically less need for COVID vaccines, COVID treatments, less respiratory issues out there. So again, good for Americans, good for consumers, good for people out there, but not so much for the company. They're also talking about the fact that consumers, because of the macroeconomic uncertainty, they're going more toward the value.
Thanks, Abigail. Shares right now currently down more than 8%. German airline Lufthansa has entered critical talks with its pilots union. The carrier is racing to reach an agreement by the end of the week to avert the threat of a strike during the busy summer travel season. Lufthansa made a contract offer last week, but union negotiators dismissed it as, quote, absolutely insufficient. Pay, sick leave, and vacation allotments are among the sticking points. Shares of Lufthansa currently up more than 2.5%. Hundreds of workers at Ford are about to lose their jobs this week. Sources say Ford wants to boost profit and lower costs in the middle of a $50 billion shift to electric vehicles. The automaker is cutting engineers in all three areas of its business. Just last week, Ford and its South Korean battery partner received more than a $9 billion loan from the U.S. Department of Energy for the construction of 3 battery plants in Kentucky and Tennessee. And Bank of America plans to open branches in 9 new markets by 2026, including New Orleans, Milwaukee, and Boise, Idaho. The expansion includes 4 states that didn't have a branch at this point. And those are the company stories we're following this hour. I'm Steve Rappaport.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. In the S&P 500, you have 9 of the 11 major industry groups higher right now. Apple, Meta Platforms, Microsoft, and Tesla among the individual leaders. On the other side, you have shares of Alphabet. They're among the laggards, down about 0.9%. The Google parent suffering a downgrade by an analyst at Bernstein. The economic data we got today look pretty solid. As a result, you have Treasury yields. They are higher. Among the data, new home sales advancing to the fastest pace in over a year. You can chalk that up to limited inventory in the resale market. Also, consumer confidence rising to the highest level since early 2022. Right now, the S&P 500, 22 points higher. That's up 0.5% at 43.51. The Dow Jones Industrial Average is up 124 points, a rise of 0.4%. And the NASDAQ 100, 94 points higher right now. That is up 0.6%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Jess and Paul.
Thank you, JT. I want to get straight to our next guest, who's a veteran investor, George Ball, chairman at Sanders Morris Harris, joins us on Zoom to discuss all things markets and his stock picks.
You know, Jess, when I came on Wall Street in the mid-'60s, George was, I believe, the chairman of Prudential Beige, which Beige and Company preceded it, and then Prudential bought Beige, one of the top firms on the street. And I'll tell you what, one of the best research departments on the street at the time.
And we're excited for him to be here. George, I wanted to pick your brain because in the last couple of months, you had been making some comments about how you thought the big tech rally had run its course, but you still were thinking the broader equity market would approach new record highs this year. Are you still thinking that'll be the case for the second half of the year?
The majority of the experts, the pundits, seem to be on the side of the market weakening as we get further into the year. There's a bit of a war between what I call Morgan Stanley on the one hand, which is predicating a $180-some earnings on the S&P 500, and then the more optimistic 220 plus S&P earnings estimates of Goldman Sachs. With, again, the majority of the experts, and they are smart people, falling on the more negative camp. I do think that they're wrong. And by the way, I'll say that my entrance to Wall Street was more in the 1970s and the 60s. But back then, way back then, 5% interest rates were common. They were accepted by business, and businesses operated very profitably with comfortable profit margins with interest rates at 5%. That's happening again today. Over the last decade, we sort of forgotten that managements and consumers and the economy can live all right with interest rates at a 5% or so level. And that, I think, is an optimistic note for the market and earnings and the economy going forward.
George, technology has been such a leader of this market really since the great financial crisis. I mean, it just felt like, really leadership position in the marketplace. Do you still think that's the case here in a world where, again, you've got rising interest rates in the 2-year treasuries at 4.75%? Can tech still be the leader?
Technology stocks have been bouncing with interest rates on the assumption that the future earnings of technology companies will be a function of dividends paid well out many years from now. But get back to the base case. Technology and the changes in technology are what's driving growth, productivity, constructive change in economies worldwide. That's not going to falter. My supposition is that the big technology companies, the FANG pluses, the 7 stocks that have driven almost all the gains in the S&P this year, are so darn big that they can't grow very rapidly anymore. They're great companies. They're doing extremely well. They're financial fortresses, but simply as a matter of scale, they've reached the point of diminishing returns. And so I'm looking at what I'd term mid-tech companies as the next wave of fundamentally justified, high growth, high contributor companies where the stocks are way down from the perhaps unjustified levels of last year, but have an enormous amount of upside potential. And that's going to start to be recognized as we get into the second half of this year. So I'm saying buy mid-tech, sell the big fangy type stocks as we get into the second half of 2023.
Hey, George, you've held leadership positions on Wall Street for decades, again, going all the way back to E.F. Hutton and Beige, some of the all-time iconic brands on Wall Street. What's your view of the business of Wall Street these days?
The business of Wall Street is much more commoditized these days than it was back then. But it is still the fount from which money for companies to grow and to expand and to diversify comes. And it's also probably the best place for individuals to put their savings, their excess cash to work. So Wall Street continues to be a marvelous place, much less humanistic than it used to be, but vital to the American economy. And by the way, one of our big national advantages, we have the ability to create money for growth much more efficiently than other economies, and it's apt to give us a competitive edge that extends into the next 20 or 30 years.
With that said, George, we got to know, what are your top stock picks?
Well, again, consistent with my mid-tech theory, I would use as specifics, but also as examples, Teladoc. Teladoc reaches over 50 million Americans. It's a company that is not yet profitable, although it's cash flow positive. If they can take just a fair slice of their client or patient base and convert it to a subscription model at fair economic prices, they have enormous ability to earn a great deal of money. Trade Desk is what the ad agencies were back in the 1960s and 70s when I started. Trade desk is a way of placing advertising or seeking advertisers on an efficient basis, and its ability to grow exponentially over the next 10 years is, I think, almost unrivaled. Mercado Libre, the Amazon of South America and Central America, is very profitable, but it's just scratching the surface. So that's a trio of mid-tech companies. They're sizable, but they're converting from a revenue growth model to a profit growth model.
George, one of the themes that's really come into this market over the last year or so is artificial intelligence, AI. And we had a well-regarded Wall Street analyst earlier says this is like the 1985 internet aha moment, or kind of like when a Google came on and we said, oh boy, this is a big moment for the internet. He said it's something akin to that. How do you view this thing called artificial intelligence, AI? It really seems to be the theme of the tech world these days.
I'm going to sound like an old fogey, and that really bothers me. I don't want to do it. I'd rather take a different view. Yeah, AI is a marvelous step forward because it's going to give people access in multi-dimensions to all of the wealth of knowledge of the world. And it will write things, it will seek things, it will display things brilliantly and very helpfully. But it is not predictive. It is a look into the database of what's known up to now. And so I don't think it's going to be transformative in the sense of being the fuel cell of growth, the way many people are predicting. I don't think it's a fad or a bubble, but I think its importance in the economic future of our country and of the world is overstated. The past is instructive, but it's not predictive. And so AI is important, but not transformative in my perhaps geriatric view.
No, it's a perfectly relevant view. But lastly, George, I have to ask, are you in Aspen, Colorado right now?
No, I'm in DeSalt, Colorado. If you can't quite afford to be in Aspen, you go 10 miles down the road.
All right, wherever you are in Colorado,
that's where I am.
All right, wherever you are in Colorado, I'm just going to suggest you might be a little overdressed. You look very solid for Wall Street, but I think for Colorado and for Bloomberg markets, next time you can certainly go a little bit more casual if you're in Colorado. George Ball, everyone, just literally an iconic person on Wall Street. He's the chairman of Sanders Harris, but has really been a leader on Wall Street for decades. I mean, CEO level leader, and it's just amazing the career he's had. Again, it goes all the way back to E.F. Hutton, and you kids can look that up. Bache & Company, another fantastic firm, bought by Prudential Securities when it became Prudential Bache and then Prudential Securities, and again, one of the leading firms on the street. So George has seen it all. We appreciate getting a few minutes of his time. Looking at the markets here, S&P 500 up 0.6%. We'll take that. And right now, we're going to head down to Washington, D.C. We're going to get world and national news, and we're going to do that with Nathan Hager.
Okay, Paul, thank you. A legal theory that argues courts should have almost no authority over federal election rules has just been rejected at the Supreme Court. The justices have overturned what's known as independent state legislature theory in a case involving North Carolina's redistricting map. In the 6-3 decision, Chief Justice John Roberts ruled that the North Carolina Supreme Court did not overstep when it tossed out a Republican-drawn map as gerrymandered. Justices Clarence Thomas, Samuel Alito, and Neil Gorsuch dissented. Prison staff are being taken to task in the latest report on Jeffrey Epstein's death. We get more from Bloomberg's Lisa Mateo in New York.
An investigation by the Justice Department's Inspector General showed no evidence to contradict the FBI's determination that Epstein died by suicide. The report found that negligence and misconduct by New York prison workers failed to stop the disgraceful financier from hanging himself. Epstein was found dead in his Manhattan jail cell in August 2019 when he was awaiting trial on sex trafficking charges. The case would have seen him go to prison for decades if he'd been convicted. In New York, Lisa Mateo, Bloomberg Radio.
The leader of Russia's Wagner mercenary group is now in Belarus. We got that word from the country's president, as Russia's Vladimir Putin told his troops they averted civil war from the mutiny attempt led by Yevgeny Prigozhin. Putin says Wagner was fully funded by the Russian government. He says he hopes no one stole anything after Russia's Federal Security Service dropped its criminal investigation. Israeli Prime Minister Benjamin Netanyahu says he has been formally invited to China. A statement from the Israeli government says he told a visiting congressional delegation about it that he told the Biden administration a month ago. Commentators say Netanyahu's using this invitation to pressure the White House. He hasn't been invited to the U.S. since he returned to power 6 months ago. Global news, 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The S&P 500 halting a two-day slide. The mega-cap stocks leading the major averages higher right now. We did have some upbeat economic data that's easing concerns about a slowing U.S. economy. It also is raising Treasury yields. Meantime, there are signs this year's tech rally might be getting a little tired. At least that's according to Stuart Kaiser at Citigroup Global Markets.
If you look at sales revisions, if you look at EBITDA revisions, they've been, higher for tech and even higher in the AI space. So that kind of sets your bar, a little bit higher for expectations. And, what we've seen the last, I would say, 1 to 2 months is long-only investors in particular starting to have some fatigue in terms of tech buying. We're starting to see some outflows from the space.
Analysts largely expect banks to sail through the latest stress tests. You have a $2.9 billion exchange-traded fund that tracks regional lenders. That was up almost 2%. And Bloomberg Intelligence has a model known as the Market Regime Index. It's flipped out of the cautious red zone, and that signals brighter times ahead for stocks, at least according to BI's Gina Martin Adams. S&P 500 right now 27 points higher. That's up about 0.7%. 43.56 on the index. Dow Jones Industrial Average, that is up 152 points. The NASDAQ 100, 139 points higher. That is up 0.9%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Jess and Paul.
All right, John Tucker, thank you so much. We appreciate that. Jess Menton, Paul Sweeney here in the Bloomberg Interactive Broker Studio. ECO Go gives you the economic calendar, and boy, was busy today. And I'm going to tell you, folks, there's some good economic data out there. I think durable goods orders higher month to month, better than expectations. New home sales higher month to month, better than expectations.
Consumer confidence.
Exactly. That's where I was going next. I mean, that looked pretty darn strong. So I don't know. Economy looks pretty good from a macro perspective. Let's bring in somebody who gets paid to do this economic stuff. Michael McKee, he covers all that stuff on the economic front for Bloomberg Television and Media. So, Michael, what's your take of some of this stuff we got today, some of this data?
Well, a technical economic term for it would be good news.
There you go.
It depends on, of course, where you sit. If you're at the Federal Reserve, this kind of raises questions about whether you need to keep raising interest rates because things are good. We had seen a narrative of business spending falling off. Now, the durable goods orders are heavily influenced by transportation. And this was no different this time. Boeing, huge.
That's what when they sell a jet, that goes into the durable goods. Okay.
You can't afford one.
Yes, exactly.
But cars were also a big contributor. But they were still up higher than anticipated, even leaving transportation out. So that's some good news. And the capital goods shipments, air and non-defense. That's kind of what goes into GDP. That was strong as well for a second month in a row. So businesses, not as much as they had been, but they do seem to be spending again, and it may be kind of a result of the fact that consumer spending has been strong, and businesses feel like we're going to have to keep up. The new home sales numbers. An astounding jump of 12.2%, but it really is, the number itself is a surprise, but the fact that we're seeing a rising new home sales, no surprise, because there's a lot of demand for housing, and of course existing homes there aren't any in the market, because who wants to give up their 2.9% mortgage to buy something at what it would cost now?
I'm taking a look at, and I'm sure you follow this too when it comes to Citi's Economic Surprise Index. How tricky does this make it for the Fed when it comes to some of this employment data? Because obviously we would want to hold it up because that would be a good trajectory for the economy. But when it comes to the rate path cycle, how does that sort of coordinate when you're looking at something like that?
Well, we're hoping, and the Fed is hoping for a soft landing. Now, the definition of that is kind of amorphous, but basically it would be the economy slows enough to bring inflation down without a big jump in unemployment. And that's about where we are right now. Unemployment went up last month. It'll be interesting a week from Friday to see what happened in the month of June. But the Conference Board consumer confidence numbers are heavily based on what happens in the labor market. And the labor market numbers in there were good. People think there are going to be more jobs available. Fewer people think there are going to be fewer jobs available. So there is an optimism about the labor market that kind of gives you the idea that maybe we're still seeing some strength there.
And we are going to have this policy panel in Europe. Fed Chair Jerome Powell is going to be there, Christine Lagarde, other big central bankers tomorrow, and then we're going to hear from Powell again on Thursday. What do you expect to hear from these central bankers?
Well, it's kind of like an all-star game in baseball.
It is.
All-star game now starting for the Bank of England, Andrew Bailey. I think it depends on your individual situation, but basically for three of them, it's going to be that we're still raising rates. The Bank of England, the ECB, and the Fed they're basically going to be saying we're still raising rates, but they will have different perspectives on how high they need to go and how long they're going to want to keep rates up. One of the things that people didn't notice as much about Christine Lagarde saying earlier that they've got to raise rates again was that she also said we need to keep rates higher for longer. That's going to become a real mantra. Then for the Japanese, it's a different situation because they've been pressured to get out of some of their easing because inflation has been going up and it is expected to rise again. Everybody gets, except for the English, except for the British, gets an inflation report on Thursday night or Friday morning. So we'll see what progress they've made. And in Japan, the Tokyo CPI is expected to have risen, which is kind of what they want. And they've been worried that it won't last. So Ueda might be able to say, we're considering some changes. Although I think this is probably a forum where they don't want to have four people pushing the markets around the world.
So, but I mean, if you look just at today's data, Mike, and I know we're going to get some more upcoming before the next Fed meeting. I mean, they're going to say, hey, this economy's strong and we can raise rates more. I mean, yet the stock market's up, so I don't know what's going on out there. But that's kind of the read here, I guess, no matter, because across the board, it seems like the economy's pretty strong here and maybe could use a little cooling off.
Well, that's where the Fed is at the moment. They believe, especially looking at the labor market.
Because also I feel like in the last few trading sessions, the concerns about recession creeped in again. Yes. And then today it kind of, that goes out the window.
Yeah, that's why the Fed doesn't listen to the market checks on a day-to-day basis, because these things go up and down and you have everybody saying, why is it going down? Well, we think there's going to be a recession. Oh, well, never mind. And so the Fed can't pay attention to that. They do watch the markets because they want to get a general view of people's feelings about the economy, but over a longer period of time than just a few weeks or something like that. As long as the markets are functioning, it's not really their concern. But they do see strength in the economy that, and the numbers are kind of showing it right now, that would keep them on track for a July rate increase, and then we'll see what happens when we get after that. It's really going to be about the labor market going forward and continued progress on inflation.
So on Friday when we get the PCE data, I want to focus on the PCE core deflator year over year.
Yes,
okay.
and
that's 4.7% is the forecast.
Yeah,
and that's down from a high of higher than that.
Yeah, it was in the sixes.
Sixes, okay.
And the headline number will get some attention because it's supposed to fall below 4.
Okay.
Which would be kind of a psychological.
And that's the one that was 9%.
Wall Street loves big numbers.
Yes.
Right, right.
Right, that's the one that was much higher than that. Now, the core services ex-housing, of course, is the Jay Powell number that you want to watch.
Ex-housing.
We should put that on eCogo.
We should see housing put some downward pressure on inflation. It's about time for that to start happening.
Yeah, it's not in Manhattan. I was just talking to my daughter, and she says rents in the city are insane. They just haven't broken. I'm like, where? But they're not coming into the office. I don't get it.
That's because they're all at home.
Right.
They're all at home doing work.
They got these nice apartments.
Right.
Now.
Exactly. Jeez, I just don't get it. You move all the way across the country to come to Manhattan to just sit in your apartment. I don't get it. All right, Michael McKee, thanks for joining us here. Michael McKee covers all the economics for us here at Bloomberg Television and Radio. Busy day today on the eco front. By and large,
it is
some pretty positive economic data coming out of the U.S. government. We're going to have more coming up. This is Bloomberg. All right, let's get some company news right now with Mr. Steve Rappaport.
Paul, Eli Lilly gets a boost in its push to dominate the market for obesity drugs. More on that from Bloomberg's Jeff Bellinger.
Steve, a study published in the New England Journal of Medicine says obese patients given an experimental weight loss shot from Lilly lost, on average, more than 24% of their body weight over 48 weeks. The lead author of the study says such results have not been seen before in a trial lasting less than a year. Lilly is looking to take the lead in weight loss therapies. It is projected that market will be worth $150 billion by 2031. Steve?
Thanks, Jeff. Shares of Eli Lilly are currently up less than 1%. Delta Airlines modestly boosted its 2023 earnings expectations as it capitalizes on a recovery in travel demand. The carrier, in a regulatory filing, adjusted profit will be at the end of its prior guidance of $5 to $6 a share. Delta was expected to earn $5.81 per share based on an average of estimates compiled by Bloomberg. Starbucks says it will issue clearer guidelines about the type of displays that are acceptable in stores. A union representing some Starbucks workers complained this month that some store managers had banned decor with pride themes. The coffee chain said it provides flexibility so stores can reflect the communities they serve. On Friday, baristas at unionized locations kicked off a 150 Strike with Pride campaign. Organizers say workers were protesting the company's illegal union-busting tactics. Starbucks denies illegal union activity. And on top of that, the coffee chain filed a complaint against the union with the National Labor Relations Board. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Jess Mint and Paul Sweeney here in the Bloomberg Interactive Broker Studio, getting a nice lift to the market today. The S&P 500 up 0.7%, NASDAQ
Consumer
up.
discretionary leading the way.
Is that right?
Yeah.
Okay, we'll take that. It's very good to see. NASDAQ up 1%, so that's good news. Yields here a little bit higher here. The 2-year Treasury is up 6 basis points, 4.74%. The 10-year only up 3 basis points, so a little bit more inversion on the yield curve. 10 years at 3.75%. And WTI crude oil, $68 per barrel, off 1.7% today. We'll keep an eye on that. So lots of movement out there in the market. A good day for the tape. Right now, let's head down to Washington, D.C. We'll get world and national news with Nathan Hager.
Okay, Paul, the Supreme Court has rejected a sweeping Republican-backed effort to oust the long-standing role that state judges and administrators play in federal elections. In a 6-3 decision written by Chief Justice John Roberts, the High Court turned aside the argument that the Constitution gives state lawmakers near-exclusive power to set the rules for congressional and presidential votes, a theory known as independent state legislature theory. The case involved a North Carolina redistricting map that the state's high court tossed out as gerrymandered. The head of Russia's Wagner mercenary group has arrived in Belarus, and Russian President Vladimir Putin is telling his troops they averted a civil war following the weekend rebellion that posed the biggest threat ever to Putin's near quarter century in power. We get more from Bloomberg's Maria Tadeo in Brussels.
It's clear there has been an ultimatum that's been given to Wagner. You give the weapons, you go away, and the troops, you either join the Russian army or you're out. And then this idea from Vladimir Putin today, saying and repeating, you averted to his troops a civil war. To me, the big question now is how will this affect the war in Ukraine? Because Wagner performed better than the Russian army.
Bloomberg's Maria Tadeo in Brussels. Meantime, Ukrainian President Volodymyr Zelensky says his forces have advanced in all directions. He visited his country's troops in the east and south. Zelensky also says he's discussed arms supply with allies. The U.S. is set to announce another $500 million drawdown from Pentagon stockpiles headed for Ukraine. Florida Governor Ron DeSantis is making his Republican presidential pitch in New Hampshire.
This is humiliating as a country, to not even be able to control your own territory, your own border.
At a town hall in Hollis, NH, Governor DeSantis promised to stop what he calls the invasion of migrants and to build a border wall. Former president and current GOP frontrunner Donald Trump has an event of his own today in New Hampshire. He'll be speaking at a lunch in Concord. Georgia's Secretary of State Brad Raffensperger is scheduled to speak to Special Counsel Jack Smith's prosecutors tomorrow in Atlanta. Smith's team has been looking into efforts by the former president and his allies to overturn his 2020 election loss. Raffensperger was on the receiving end of a 2021 phone call in which then President Trump urged him to help find the votes to reverse President Biden's narrow victory in the Peach State. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager in Washington. This is Bloomberg. Paul and Jess.
Thank you, Nathan. We appreciate it. Paul, I was taking a look at one of the read spikes in the terminal today and taking a look at how the CFA level 1 pass rate rose to 39%. So it's getting closer to that historical average. Over the last decades, it's actually been around 41%. But obviously, during the pandemic, it was pretty tough there, especially for people that were studying during that and had a lot of those different disruptions. But you're seeing that improving. I think this is the second time now coming out of the pandemic where we've seen some of these pass rates improve prior to obviously what we had seen the last couple of years.
Yeah, I mean, it's a very intensive
Such a
test.
rigorous,
wow.
rigorous
You know,
exam.
there's three levels over, at best a 3-year period, and it's very, very rigorous, and people put in
so much time.
So many hours. Yeah,
Everybody I know that has
dozens,
gone through it, it's probably taken them more than 3 years to do.
Yes.
Even the fastest pace is obviously doing within that span.
Yeah, exactly. And I can't imagine having to go through that intense studying
while you have a full-time, full-time job, pandemic,
right,
life and
lockdowns
kids.
and all this kind of stuff. The good news is now you can take this test digitally. It was, always ink on paper, but they, I guess, kind of changed with the times there during the pandemic, and that hopefully makes it a little bit easier for everybody. But CFA level 1 getting back a little bit more normal, and that's good to see. All right, we're going to have more coming up. More Bloomberg Market starts right now.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to talk to Matt Cheltenham. He's the senior litigation analyst of Bloomberg Intelligence. The government's looking at Amazon in so many different ways. Right now, the FTC is looking, they have a lawsuit against Amazon, and we're going to talk to Matt Cheltenham about that, about some of the other litigation against the company. Kevin Tynan, he's in the building in Bloomberg HQ, so we grabbed him. He's the senior autos analyst for Bloomberg Intelligence. We're going to talk everything about the car business. We might even talk a little Tesla, but Ford laying off some people, so that's interesting. Plus, Ankur Daga, he's the CEO of Angara. He's going to discuss his company's growth in the U.S. and the jewelry industry in India, so that should be interesting. Coming up in this hour. But first, we're going to kick it off with Charlie Pellet.
Hi, thank you very much. And here's what's going on, Paul Sweeney. Best level of the day right now on the S&P 500 index. Sharp contrast to yesterday, right to the numbers. S&P up 30 points. That is a gain of 0.7%. Dow Industrials up 145. That is a gain of 0.4%. And the Nasdaq Composite Index up 137 right now, up by 1%. Russell 2000 also advancing, up now by 1.1%. 10-year yield 3.75%, with the 2-year yielding 4.74%. Spot gold lower, little change, down $9 the ounce to $19.13, while West Texas Intermediate crude back with a 68 handle, now down 1.8%, $68.12 a barrel on WTI. Bitcoin 30,510 right now on Bitcoin, up by 1.1%. Home prices rose for a third straight month, pushed up by growing buyer demand for a tight supply of listings. According to seasonally adjusted data from S&P CoreLogic Case-Shiller, a national gauge of prices increased 0.5% in April from March. Steve Ricciotto is chief economist at Mizuho Securities.
There certainly seems to be a bit more resilience in home pricing than anyone anticipated, and that's continuing to keep up rents, and therefore inflation is going to be stickier than the Federal Reserve has been anticipating, and that's part of the problem. They've been anticipating this reversal in inflation without a recession, and I don't see how you're going to get that, and the data today is certainly indicating that's not going to happen.
And you can hear more of that conversation on the Bloomberg Surveillance podcast. You can download it wherever you get your podcasts. Delta Airlines is boosting its 2023 earnings expectations as it capitalizes on strong demand and a drop in jet fuel prices at the outset of the busiest travel period of the year. Delta shares, they're flying higher now by 4.6% among other airline stocks today. American up 5.6%, UAL United up 5.2%, Southwest up 3.5%, JetBlue surging now by 7.4%. Recapping, we've got the 2-year 4.73%, the 10-year 3.75%, while the S&P 500 index is up 29 points, up 0.7%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate it. Boy, one icon, Charlie Pellet, to another icon.
And you know, whenever I'm talking about those taking stock columns, this is the guy who edits them.
I know, and he's does he ever is he a good editor, or is he one of those guys that's like a pain?
No, he's the best.
All right, we'll go with your work on that.
You have to ask her that one off the air.
Yeah.
Exactly. All right, Mike Regan joins us. He's senior markets editor here. Mike, what are you seeing in the market here? We're getting a little bit of a lift here. I'm not sure what's driving it. What do you think?
Well, you always have to factor in that quarter end or half year, month end rebalancing, which should be a negative for stocks right now. You know, we saw this massive outperformance of stocks versus bonds, both in the first half and the second quarter. Now, it's an influence. It doesn't mean that that's what you're going to get necessarily. But I do think that would probably be my prime suspect for why we've sort of come down since the middle of the month, is because my colleague Cameron Kreis, who also has a very excellently edited column on the Terminal, has done a lot of work on this, and he points out that reaches its peak. That rebalancing trade reaches its peak about 5 days before the end of the quarter. So that weakness we saw might have already been that. You expect that rebalancing to show up in the last minutes or hours or last couple of days of the quarter, but his work shows it's really about a week out. So sure enough, that it kind of corresponds to when we started to see this market roll over. So we might be through a little bit of that. But the other big thing, Paul, I think about is, and to toot my own horn here, we had Jared Gross of JP Morgan on the podcast, What Goes Up, last week. And he talked a lot about what's sort of normalized after COVID and what hasn't normalized. The central bank put being something that's just gone. Now.
Yep.
And so when you look at the eco data that came out today, I mean, everything was good. Durables, home prices, home sales, consumer confidence. Richmond Fed was a little weak, but, I've never seen that really move the needle too much. So we're in this world where good news, I think, is good news again on economic data, rather than the days of the Fed put when you'd see strong economic data and think, oh boy, they're not going to cut or they're going to raise rates more aggressively than we thought. I think the Fed has telegraphed as well as they can what's in store, that maybe we'll get another hike or two, maybe it'll be a pause, but a cut is very, very unlikely. So bad economic data, I think, is going to be treated like a bad thing, unless it gets so bad that put comes back into play. But I think we're a million miles from that. So, good economic data, I think, on its face is a positive for the market right now.
And NASDAQ 100, as you know, on pace for its best first half to a year ever. We'll see if that can continue. When you're speaking with your sources, what are their expectations as far as what could be the catalyst to continue this rally in the second half of this year?
I think it's really if we see more fundamentals attached to the AI theme, because we already have seen, what was surprising about the AI hype is that it had all of the sort of hallmarks of speculative, hype-fueled momentum, except for the fact that the fundamentals were right along with it. That NVIDIA forecast, a lot of people I've talked to said, I've never seen a company raise a forecast like that. So whether or not AI is going to be the productivity tool and sort of that margin expansion tool in practice for companies using it is kind of irrelevant, because we know these companies are going to spend in an effort to do that. So your chip makers, your cloud computing companies, anyone who is in the infrastructure of AI, something you have to buy into in order to be an AI practitioner. I think, that's where the focus is going to be. Are these companies going to be the beneficiaries of capital spending? There's still a lot of excess cash on balance sheets of U.S. companies compared to pre-pandemic. So there's money to spend. Maybe instead of buybacks or raising your dividend, you do a big push into AI. And I think that's what we got to wait and see.
We had Dan Ives on, senior technology analyst for Wedbush Securities earlier, in his brutally ugly shirt. He was in our studio, but he put a number on it. He thinks there could be up to $1 trillion of incremental tech investment over the next couple of years as it relates to AI. And there's lots of ways to play it if you think about that backdrop.
Yeah, and that's even before we get to, if you're the company that's trying to use AI to protect your margins or expand your margins, we'll start seeing those numbers further down the line, next year. But the spending on the nuts and bolts, the chips, the cloud, your servers, I think is where the primary focus is now. And you think about that, $1 trillion in incremental spending. I mean, does that validate a 30% first half gain in the NASDAQ 100? Maybe not, but I've seen worse things, that have driven that type of euphoric
It's better
rally.
than 1999 when we weren't really sure what was behind
the
move.
You knew something was going to go on, but it's the same and it's different in that, back then everyone wanted a website. Right. You added .com to your name even if you were selling dirt. And
a funny story in that I took a company public back in 97, 98. So it was the beginning of the .com, or solid in the .com boom. The company's name, it was a radio company. It was called Entercom.
Oh, yeah.
Intercom.
And we had so many wacky inquiries and orders flooding into the trading desk on the day of pricing because it was literally somebody heard that another .com was coming public, and it was just crazy.
Because it had .com in the name.
Yes.
Yeah.
So hopefully we're not at that level. All right, Mr. Regan, thank you so much for joining us. Mike Regan, he's the editor of Bloomberg Markets. He's responsible for all these crazy reporters that we're bringing through, led by Jess Menton, by the way, coming through, giving us these market breaks. Appreciate that. All right, let's talk about our good friends at Amazon. We've all got boxes probably sitting in front of our doors as we speak. Of
course.
Our good friends at Amazon. And then there's a little thing called Prime. I'm a huge fan of Prime.
Oh,
you get
I love
free
it.
delivery, you get some of their audio, their video service, all kinds of stuff kind of wrapped up in there. But apparently the FTC is taking a look at this thing. Matt Cheltenham, he's a senior litigation analyst. That means he's an attorney, but he's come over from the dark side and is working on Wall Street and giving us some good research for Bloomberg Intelligence here. Matt, just describe what the issue the FTC has with Amazon and its Prime business.
Yeah, Paul, we saw this emerge somewhat surprisingly last week when the FTC filed this lawsuit on Wednesday alleging that Amazon has tricked or duped millions of consumers into signing up for Prime and in particular for the automatic renewal of those Prime membership. And the allegation is that violates a federal law, and that Amazon's potentially on the hook for hundreds of millions of dollars or more in damages for tricking consumers into staying with a program that they don't really want to be a part of.
And it's interesting because going through this, it says the FTC was talking about how consumers must click through 5 pages on the desktop web store or 6 on the mobile app to cancel Prime. So clearly making it pretty difficult, right, for consumers to try to cancel this. I mean, how much and how far do you think this potential case could potentially go?
Yeah, so I mean that's exactly the allegation. What's really the big unknown here, though, is what is simple. The law requires a simple mechanism for subscribers to cancel automatic renewal plans like this.
How about talk to the cable television companies? How hard is that to cancel?
Exactly, and that's exactly what you're going to hear from Amazon in this case. Is look at all these other businesses that make it so difficult. You want to cancel your gym membership. You got to go into the gym to find somebody to talk to. Other companies require you to call somebody on the line. Here we're talking about 6 clicks, and yeah, there are some extra hoops along the way, but there's very little guidance in the law on what is simple and what isn't. And so, I think there's a real argument for Amazon to make here that the FTC is really straining to argue that this 6 clicks process violates the law.
I mean, to me, first of all, I don't feel like I was duped.
I actually had an issue when it came to Audible. When it comes to their podcast, I actually went through this a couple months ago where I canceled and then kept getting charged and had to call them and go through this. So it's interesting now that I'm reading through all of this, but I kind of felt a little miffed there when that had happened to me.
So, Matt, what's Amazon's MO when dealing with regulators? Do they just settle these things out of court, or do they fight them to the tooth and nail?
Yeah, so I mean, for a company like Amazon, it's really hard for a suit like this to be too threatening. But one reason it does matter is that the FTC's power to impose penalties is very broad. In theory, the FTC can impose $50,000 per violation, and that can be counted by user. So you start to go 100 million times 50,000 and you get to some gigantic number with lots of zeros at the end. So Amazon has to pay attention to this, especially when the leader of the FTC, Lena Khan, is looking to be very aggressive in going after companies like Amazon. So I think Amazon would be happy to settle it for a small figure, relatively quickly. It's unclear whether the FTC would go on, be on board with that right away. But, I really do think Amazon has a good chance to prevail in this litigation, but it's going to take time. And so I do expect it to play out for a couple of years before we see a resolution. But it's really hard to see the FTC winning a material damage amount against Amazon here ultimately.
So the timetable, like you said, being potentially a couple of years when it comes to this.
Yeah, that's what I think. So this was just filed last Wednesday. I think you're likely to see a couple rounds of this litigation, and the big risk for Amazon is this gets to a jury that could potentially offer a damages award in the millions or even billions of dollars. That's what you can't let happen. But there are two steps in the litigation process before we get there. One, Amazon can file a motion to dismiss the whole thing and says, look, this doesn't even state a valid claim. I don't think that will work. It has a chance. But then even after a year or two of discovery, when they dive into the evidence, Amazon can say, look, the FTC collected all this evidence, and there's still not a case that should go to a jury. That's when I think Amazon has a really good argument to the judge to say, look, Amazon's process may not have been perfect, but it's probably enough to qualify as a simple mechanism under this unclear standard under the law. So, yeah, I think that's going to take a couple of years before we see any action, and certainly before it goes to a jury in a trial-like setting.
Hey, Matt, we've been talking to Jen Rhee, who covers antitrust for Bloomberg Intelligence, and just talking about kind of the regulatory environment out there for businesses, particularly big tech, and it's really tough for big tech companies to really do anything here. From your perspective, from the litigation side, what's the environment like out there for business? Is it tougher to do business? Is the government really taking a harder line?
It's certainly, there's been a change, certainly in, the past 5 to 10 years. Well, in Washington, D.C., on the regulation side, we had this idea that for a couple decades, look, it's best to get out of the way of the internet, let the internet thrive. Everything has sort of changed in terms of policy, in terms of, okay, maybe we went too far in that direction. And you're seeing the same thing on the litigation side, where class action lawyers see opportunities to go after companies like Meta and Google for, potentially addictive social media. You're seeing Section 230, the liability shield that has long protected these companies. Suddenly people are suggesting maybe we've read that liability shield too broadly. Maybe we should be able to sue these companies about harms. And so it's an onslaught of different attacks that they didn't face 5 or 10 years ago. That doesn't mean they're going to lose these cases. The companies have strong defenses to a lot of the claims, but it's definitely a more difficult environment than it was a couple of years back.
And that's why Bloomberg Intelligence has a bunch of analysts and lawyers and smart people down in Washington with their fingers on the pulse of what's happening down there, so they can provide some very valuable research to Bloomberg customers. So Matt Shenhelm is certainly one of them. He's a senior litigation analyst for Bloomberg Intelligence based down in Washington, D.C., so we'll have to follow that for Amazon. The numbers, relative to its market cap aren't material, but it goes to, one of their core business practices here. So we'll see how they continue to fight this. But again, it's tough to fight the government, the Federal Trade Commission, but I guess if anybody can do it, it's Amazon. S&P 500 up 0.7%. We're going to have more coming up. This is Bloomberg. All right, let's get some company news right now. Let's Steve Rappaport.
Paul, OD Asset Management is in advanced talks to transfer 4 equity funds to SW Mitchell Capital. Investors have been exiting the firm in droves following sexual allegations assault against founder Christian Odie. Earlier today, the company suspended 2 more funds, including its flagship fund. Bloomberg financial editor Michael Moore reports.
In some ways, it's not a surprise because Chris Benodi was the main portfolio manager on this fund. You have to imagine that fund has shrunk in recent years. Those who had held on seem to be believers in Crispin. So now that he's gone, you kind of lose that superstar who was running that fund. So both funds that we're seeing today, the flagship and the other one who are suspended, were both had Chris Benodi as a portfolio manager. We've also seen other funds that he didn't run also have to be suspended because of the redemption request.
Thanks, Michael. Shares of Walgreens now down 9% after the drugstore chain slashed its adjusted earnings forecast for the fiscal quarter. And Barbie's dream house is back on the market for a dream vacation. Bloomberg's Gina Cervetti has more.
Airbnb is once again offering Barbie fans a chance to stay in a life-sized recreation of the iconic doll's dream house, this time for free toward the end of July. The oceanfront mansion in Malibu, California has been renovated in pink and is back among Airbnb's offerings to promote the upcoming Warner Brothers movie about the Mattel doll. This time the stay will center around Barbie's boyfriend, Ken.
Thanks, Gina. Those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets coming up right after this here on Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long at Bloomberg. Stocks are pushing higher. The NASDAQ 100 index up now by 1% to power a rebound in stocks. The Dow, the S&P, NASDAQ all advancing, and so is the Russell 2000. Right now we've got that index of small cap shares up by 1.2%. Here's where we stand. The S&P is up 30. That is a gain of 0.7%. Dow Industrials right now up 130 points, higher by about 0.4%. S&P up 0.7%. NASDAQ up 1% right now. And again, the NASDAQ 100 index up 1.1%. 10-year yield 3.75%, with a 2-year that's yielding 4.74%. Spot gold down $8 the ounce to $19.14. That is a drop of 0.4%. While West Texas Intermediate crude down 1.6%, $68.28 for a barrel of WTI. Stellantis, the owner of the Jeep and Ram brands, is setting up a business unit focused on electric vehicle charging as it prepares to roll out new fully electric models in the U.S. next year. Stellantis shares are up now by 1%. More on the auto industry coming up in just a moment right here on Bloomberg Markets. Again, recapping, stocks higher across the board. A rebound Tuesday. S&P up now by 30 points, a gain of 0.7%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate it. Let's get right to our next guest because we got him live in studio.
Yes,
Jess.
in studio. I love this.
I know. Kevin Tynan, Senior Automotive Analyst for Bloomberg Intelligence. He's based down on our Princeton campus, but occasionally he gets up to the big town. Kevin, thanks so much for joining us. Lots of ways to go here, but first I got to start. Your Mercedes that you drive is a V12?
It is.
Does that mean it has 12 cylinders?
12 cylinders.
And I have 6 in my car?
That's right.
So you have twice as many?
That's correct.
Why?
And it's here's the beautiful thing is it's a 2001 Roadster V12 with, I don't know, 96,000 miles on it. So my carbon footprint is actually smaller than anybody who made them build a new EV.
All right, that's all right. So I had to clear that up there. I thought I was a tough guy with 6 cylinders, but you're driving around 12. Great. All right, let's start with Ford. Ford cutting some jobs here. Why?
Yeah, you know what I thought was interesting about this was that you don't have this condition in the industry, or at least in North America, of oversupply, right? Like too big, too much product, too much production capacity, and we need to cut back. You know, inventory on the ground industry-wide now in the U.S. is about half what it was at the peak, which would be, peak volume year was 2016, 17.5 million. We'll do 15 this year, 15.5 at the outside. You know, so inventory is really in line with demand for the most part, and you're seeing rationalization of costs still, which my conclusion is that this industry is very different than what it used to be, which was a lot of fixed costs, a lot of overhead, produce, figure out how to sell it tomorrow by giving it away, incentives, discounting, lease deals, whatever it is. And to me, these job cuts really show that the mindset of the manufacturers, auto manufacturers, is we're not going back to that world.
Oh, okay.
I wanted to turn toward Tesla because we are seeing its stock higher more than 1% today, so that is pushing discretionary shares higher, and obviously it's weighting in the S&P 500 close to about 2%. We did see that downgrade from Goldman Sachs on Tesla earlier this week just because of the difficult pricing environment, but we saw that huge run Tesla had been on that was snapped earlier this month. Obviously it was a 13-session span. Stock gained over 40%. I know that Paul's been watching RSI levels very closely. So it actually got to around 88 earlier this month, obviously above 70s, that overbought level. But what are you seeing when it comes to Tesla's stock there? And does it make sense that we've seen a little bit of a pullback after such a strong run like that?
Yeah, well, the difficult part, you know, as an analyst is to make sense of what the Tesla stock does. It's its own product.
Right.
Compared to what the fundamentals of the company or of the industry are. So, you know, I think the longer we go, we see that this is an automaker, right? There's obviously big technology competitive advantage is at least perceived. And we saw the idea of the charging with GM and Ford signing on with that pushes the stock price higher. But ultimately, this is an automaker with automaker demand issues. I was actually driving around with my wife this weekend, and we drove by one of the malls, the Quaker Bridge Mall.
Oh,
and
yeah.
there in the parking lot, there's overflow Tesla inventory as far as the eye can see. I actually made her pull over, and I got out and took pictures for myself. But so when you look at it from the perspective of a metal bender that needs to produce and sell, and you take some of that technology angle away from it, you're going to have those periods where the stock just adjusts.
Yep.
And then you're going to have periods where there's an announcement and it makes a big difference to the upside.
And one of the things I'm still trying to get a sense of is, if I were a Tesla investor or an analyst, is kind of where it fits into a world that's going completely electric. And they get all the credit in the world for being first and being really, really, really good. But in a day, it's, as you suggest, it's a metal bending business, and Ford, GM, VW. So when I think about Tesla, Rivian, Lucid, all these other ones, how do you think this industry is going to shake out?
Yeah, I think we're through a period where markets, investors talked about the auto industry like it was the tech industry, or these were tech companies, and they always have been, right? Automakers have always been ahead of the curve technology-wise, developed some great things over the years, and I think there was this belief that because of Tesla that this entire industry was now all of a sudden a technology industry. So what you get is you're either going to get every other automaker that is essentially doing and can do the same things as Tesla be considered tech companies and deserve those valuations, or you're going to get the ones that had the wild technology valuations, recalibrated down to automakers. And I think that's the greater likelihood. Ford and GM are never going to be, and have never been, valued like that. And I think the reality would be more that the EV and technology companies would be valued more as automakers than the reverse.
And our friend Matt Miller actually interviewed Ford's CEO Jim Farley about a month ago. It's actually toward late May, about cost cuts, auto prices, EVs, when it comes to Ford in position to some of these other competitors that we're talking about, and obviously its outlook for the next few years. Do you think that's sustainable, and do you think it could happen?
Well, yeah, I mean, I think profitability is going to drive adoption, right? These are automakers, the legacy automakers are making a lot of money doing what they're good at, which is trucks and SUVs, and then being asked or forced into this transition to EV when it's not really ready. And I understand the concept of disruption, and that's what happens, and some things are messy during the transition. But during the period where we transitioned to truck from car, that was profitable on the first day, right? So now you have, Tesla leading the way, but the government's starting to get involved with credits and infrastructure spending, motivating the consumer to demand these things that the manufacturer can't necessarily make money on just yet. And it's a messy transition period right now, because you don't want to give up profitable things to do unprofitable things in this market right now.
I drove the Ford F-150 electric one, and it's the first time I drove a pickup truck, probably the last. I don't drive. I'm a Wall Street guy. I'm not driving a pickup truck. My son's got one, but and it was my first electric vehicle, and boy, it blew me away in terms of the power and the torque and things like that. Is the belief in Detroit that the average pickup truck driver will demand an electric version?
Well, I guess it's going to depend. I mean, the towing capacity, the range, there's, and look, and what I would say is this, is that it's why we have segments. It's why we have vehicles with different capabilities, so different drivetrains. I got 12 cylinders, you got 6, like that's how make the world go round. So the idea that maybe the technological singularity of internal combustion being traded for the singularity of electrification, for me, is a difficult concept, because I feel like there is a place, there's people that need, but I'm not sure we're ready to say 100% this is your only option in terms of drivetrain technology.
I hear you're speaking at a Bloomberg Intelligent event today.
Yeah, right upstairs.
All right.
And what are we doing there?
That's the BI Lithium conference. So I'm the square.
You're the that's right. You're the auto guy.
I'm the square peg.
And just what is the? We got 30 seconds left. Kevin. What's the consensus out there on the street about lithium batteries? Is there going to be enough stuff? Are we going to be able to get them all? And
no, that's one of the things. And I was out last week speaking at a couple of dealer conventions, Louisiana dealers, Virginia dealers, and that's the big question. Is we hear this 100% by whatever date, and it's when you total up the market share and the volume, it just doesn't compute with the materials that we have access to. And the most cynical of them would say, look, we're essentially trading our dependence on foreign oil for our dependence on China materials at this point. But a lot of people don't want to talk about that.
But you will. That's why we bring Kevin along. Kevin Tynan, Old School Auto. Kevin Tynan, Senior Automotive Analyst for Bloomberg Intelligence, joining us here live in our Bloomberg Interactive Broker Studio. We appreciate that. The industry's going electric. I don't know. I still have my 2014 BMW 535 with manual transmission, and I'm sticking with it until they pry it out of my cold, dead hands. Right now, let's head down to Washington, D.C. We'll get World and National News with Nathan Hager.
Okay, Paul, thank you. The Supreme Court has sided with North Carolina's High Court in upholding judges' oversight role over federal elections. In a 6-3 decision, Chief Justice John Roberts ruled the court was within its rights to reject a redrawn congressional map. This is Loyola law professor Lori Levinson.
That actually rejected the independent state legislature theory, which would have allowed North Carolina to draw any kind of lines that they wanted for their election maps, and would have given the Republicans full power without oversight by the state Supreme Court or even the federal courts.
Loyola Law's Lori Levinson. Negligence, misconduct, and outright job performance failures, they are all getting the blame in the latest report on Jeffrey Epstein's jailhouse death. In a social media video, Justice Department Inspector General Michael Horowitz said New York prison staff should have known Epstein was laying the groundwork to take his own life.
Had Epstein's cell been searched as required, it would have revealed that Epstein had excess prison blankets, linens, and clothing in his cell. MCC New York staff also failed to ensure that the institution's security camera system was fully functional, resulting in limited recorded video evidence.
The Inspector General's report said there is no evidence to contradict the FBI's finding that Epstein hanged himself in his cell. The leader of Russia's Wagner mercenary group is now in Belarus. Russian President Vladimir Putin told his troops today they averted civil war after the weekend mutiny attempt led by Yevgeny Prigozhin. Putin says the Wagner Group was fully funded by the Russian government. Russia's defense ministry says the mercenaries have begun transferring heavy weapons to the Russian army as the Federal Security Service has dropped its criminal investigation into the mercenaries. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager. This is Bloomberg.
Sports, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long at Bloomberg. The Dow, the S&P, NASDAQ continue to power higher, and right now we have got the S&P 500 index at the best level of the day. Up 37 points right now. That is a gain of 0.9%. Dow Industrials up 174, higher there by 0.5%. NASDAQ up 159 right now. That is a gain of 1.2%. 10-year yield 3.75% with a 2-year at 4.73%. We have got spot gold lower by $8 the ounce now to $19.14, drop there of 0.5%. West Texas Intermediate crude down 1.6%, $68.29 a barrel. Bottom line here, stocks are rebounding today amid a rally in big tech. Right now, we have got, as I mentioned, the NASDAQ 100 index up by 1.3%. Certainly, the NASDAQ 100 index outperforming this year, up 35.9%. Dan Ives is a senior analyst at Wedbush Securities, and right here on Bloomberg Markets this morning, he was pounding the table on tech.
You know, I believe based on everything we've done, this is the biggest transformational tech trend that we've seen. And we were talking about $1 trillion of incremental spend that's now coming into the tech ecosystem, which is why, in my opinion, this is a green light to own tech. I think it's going to get broader and broader in terms of the rally. And many of the bears that continue to say this is hype, they're not talking to the CIOs, the CTOs, the IT spend, whereby I think it's something unlike I've ever seen.
And you can hear more of that conversation on the Bloomberg Tape podcast. You can download it wherever you get your podcasts. So again, recapping here, we do have stocks advancing here. S&P 500 index right now up by 0.9%. The NASDAQ 100 index up 1.3%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pella, thank you so much. We appreciate that. One thing we don't talk about, we probably should, because it's significant asset class, if you will, alternative asset class, which is jewelry.
Yes.
Our next guest can help us do that. Ankur Daga joins us. He's the CEO of Angara, and he joins us here in our Bloomberg Interactive Broker Studio. Ankur, thanks so much for joining us.
Absolutely. Great to be here.
Tell us about your company. What do you guys do at Angara?
So we specialize in colored gemstones, so ruby, emerald, sapphire. We are vertically integrated, so we do everything from buy from the mines, cut and polish gemstones, design jewelry, manufacture jewelry, and retail over the web in over 30 countries.
And you grew up in the jewelry industry. Talk to us about how you got started.
Yeah, absolutely. So I did. From the age of 5, I was going to my dad's wholesale business, and I initially vowed that I would never come back into the industry because it was quite antiquated. And like Paul, I worked at Credit Suisse before, and then McKinsey. My largest project at McKinsey was turning around a jewelry retailer. And I was like, wow, there's a lot of opportunity here. And then there we are.
All right, explain to me this thing. I know nothing about it. You know, I'm going to say natural mined diamonds versus lab-grown diamonds. I didn't even know there was really a thing for lab-grown diamonds. Talk to us about lab-grown diamonds.
Yeah, so they've been gaining popularity over the last 3 years. So 2018, the FTC said a lab-grown diamond is a diamond just like a natural diamond is. The only caveat is you have to disclose that it's lab-grown. Since then, the industry has really taken off. So in 2020, there were roughly 2.3% of all diamonds sold. Now they're over 10%. And the growth rate obviously is fantastic, but in terms of unit volume, it's even more so now. I think part of why they are so attractive is now they are trading at 75% to 90% cheaper than their natural mined equivalent.
Really? And what do they look like? How do they?
So they are optically, physically, chemically identical to natural. So they really are a perfect substitute.
So what's that done for the price of natural diamonds?
That is a significant issue. So our industry generally has not been prone to technological disruption. Right. This is the first time. So over the last 12 months, diamond prices have gone down anywhere between 18 and 24%. And I think they're going to go down by another 20 to 25% over the next 12 months.
And how did COVID play into that in the direction of diamond prices?
So COVID was another anomaly for us as many other industries. commodities. Asset prices for diamonds specifically went up by 25% between, let's say, June 2020 and June 2022. But that demand has now moderated. During COVID, people couldn't go out. They couldn't eat out. They couldn't travel. A lot of that stimulus money went into luxury, especially jewelry, and now we're seeing a moderation of that. But what's now causing the further dip is really technology and lab-grown diamonds.
And what exactly was the catalyst for those prices moderating?
So demand has receded a little bit after the pandemic has come off, because now people are traveling a lot more, they're eating out a lot more. So they're balancing where they're spending their money again.
So your company, over 400 employees, where are they and what do they do?
Sure. So we have now 10 offices across the world. LA is our headquarters. India is our largest operation, followed by Thailand.
Okay.
And then Ireland, UK, Australia, Canada to add.
Interesting. Okay. So talk to us about kind of some other gemstones and how do they compare as investments? Because I know a lot of people think about them. It's not just what I wear around on my finger or around my neck. It's an investment for me. How does those gemstones perform?
That's right. So colored gemstones, as opposed to diamonds, are seeing a great boom over the last 3 years. So the S&P 3-year CAGR is around 11.5%. Rubies have gone up by 17% per year, sapphires by 12% a year, emeralds by 13%. Some of the more niche gemstones like opals and tourmalines are up anywhere from 20% a year to 36% a year. So they're crushing the S&P as we
So there's this growing appreciation for more colored stones as an asset class.
That's right, yeah. So there's a few tailwinds that color stones are experiencing. I think one is we're kind of going from this unipolar world where the U.S. dominated. So 10 years ago, the U.S. was by far the largest consumer of colored gemstones. Now we have India, which has historically been what I would describe as a gold jewelry market. Now, as they get more sophisticated, diamonds and gemstones are catching up. And China gemstone consumption is even more so than in the US. So we have other tent poles across the world that are consuming more. So there's a supply-demand imbalance. At the same time, on the supply side, mines are genuinely running out of material that they're mining. So, for example, the Burmese mine for rubies has shut down effectively. The Kashmir mine for sapphires has shut down. Colombia, a major emerald producer, is really reducing output. So at the same time that demand is rising, supply is reducing. And we think that's going to continue over the next few years. I think the other thing for gemstones is when people are now realizing that diamonds are depreciating as an asset class, traditionally both diamonds and gemstones have really been inflation hedges, but because color stones are appreciating, more and more money is going there that we see.
You think about some of those spy movies where you get payment in diamonds, because you can't take all that cash.
Right.
But now that's not such a good thing, right?
Something I was curious about is what happens if you have it juxtaposed where diamond prices are falling, but then you have these gemstone prices that are rising. Is there a typical something that can happen there with the swings in prices when you have them diverging like that?
Yeah, I think what we are seeing is much more of a transition to color because it is a better investment over time. The other thing is I think just in terms of culturally, color is becoming much more commonplace. So for example, Rolex, Audemars Piguet, Patek Philippe, their higher-end watches, their most coveted watches now have gemstone bezels around the dial. We think we also have a part of it. Is we're typically now known within the industry as the De Beers for color stone. And the idea is, starting 1948, De Beers came out with the diamond is forever and the 4 Cs, and there was this idea that there is a singular perfect diamond, which is the D flawless. Now, us as a society, we've changed considerably where we're celebrating uniqueness, we're celebrating diversity. We're also celebrating what we like rather than what we're told we should like. And that transition, we're moving the market towards color with really a focus on education and customization of jewelry.
All right, 30 seconds left. What's the future of your company over the next few years? You got, $100 million in revenue roughly?
That's right. So we've grown 4x in the last 3 years. Our next target is $1 billion. I think we can achieve it in 5 years. So that's the goal.
Really? Awesome. That is good. We're going to keep in touch with this guy.
Bring it back.
Yeah, awesome. Well, congratulations. Fascinating discussion. I learned a ton there, particularly about the lab-grown diamond prices. So do you go to your fiance and kind of slip in a real diamond, but it's a lab-grown one? I don't know. What do you do there?
I mean, look at these emeralds. This is my birthstone, so I keep looking at that. Up about 13%.
Yeah, good stuff. All right, Ankur Daga, thanks so much, CEO of Angara, joining us here live in our Bloomberg Interactive Broker Studio talking about the jewelry business. Fascinating discussion. We will follow Encore's company going forward. We'll have more coming up. This is Bloomberg.
Okay, I guess I'm going right in. Walgreens stock fell the most since late 2020 after the drugstore chain slashed its fiscal year earnings forecast. Bloomberg's Abigail Doolittle has the story.
The range is now $4 to $4.05, from $4.45 to $4.65. The company seeing dramatically less need for COVID vaccines, COVID treatments, less respiratory issues out there. So again, good for Americans, good for consumers, good for people out there, but not so much for the company. They're also talking about the fact that consumers, because of the macroeconomic uncertainty, they're going more toward the value.
Thanks, Abigail. Currently, Walgreens shares are down more than 9%. Internships didn't pay anywhere close to this when I was in college. Wall Street is giving more money to students learning the tricks of the trade. Bloomberg's Tom Busby reports.
Median intern salaries jumping 19% at 16 top firms studied by the compensation firm Levels FYI. At hedge funds and prop trading firms, hourly pay up 29% this year to a median of $111. Bank of America paying $41 an hour, $5 more if you're interning in New York City. Citigroup, $50 an hour. And Citadel Securities paying $120 an hour.
Thanks, Tom. Health insurance companies recently reported an increase in people services, but what's behind it? A UBS analysis points to pickleball injuries. The firm estimates pickleball injuries will cost Americans $500 million this year. UBS looked at the data and found the majority of injuries occurring among players age 60 or older. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Jess Met and Paul Sweeney here at the Bloomberg Interactive Broker Studio. Jess, Ryan Seacrest is not going to replace Pat Sajak on Wheel of Fortune. The guy is everywhere.
He is. I don't know when he sleeps.
I mean, I'm sure it's a huge gig, but I mean, the dude is just he's everywhere. He works at so many different things. It's just unbelievable. All right, good stuff.
He still has a radio show, too, I believe.
He still has a radio show. Well, who wouldn't? You want to give up the radio show. All right, right now, let's head down to Washington, D.C. We're going to get world and national news, the important stuff, with Nancy Lyons.
Thanks, Paul. Belarus's president says the Wagner Group's Yevgeny Prigozhin is now in his country, in line with an agreement negotiated with Vladimir Putin to end the weekend revolt in Russia. Putin today said Russia averted civil war after the mutiny by fighters loyal to the mercenary leader. Well, we've seen the transcript of a conversation that former President Trump had at his Bedminster Golf Club, in which he was holding a Pentagon document with plans to attack Iran and referring to it as secret information. Now, the actual audio has been released by CNN.
As president, I could have did less, but now I can't.
The clip is a key piece of evidence in special counsel Jack Smith's case against the former president in the classified documents case. Trump is claiming Smith illegally leaked and spun that audio, and he says it's actually an exoneration of the charges. In related news, Trump's aide missed his arraignment in Miami federal court this morning on charges associated with the documents case. Walt Nauda's attorney says his client was unable to make his flight, so the judge moved the court proceedings to July 6th. Well, the Justice Department's internal watchdog says there were multiple failures as well as misconduct by New York prison staff in connection with Jeffrey Epstein's death by hanging in his prison cell. Michael Horowitz is the inspector general and posted his results in a video on social media.
The combination of negligence, misconduct, and outright job performance failures documented in today's report all contributed to an environment in which arguably one of the most notorious inmates in the BOP's custody was left unmonitored and alone in his cell with an excess of prison linens.
Horowitz says there was nothing to contradict the FBI's determination that he died by suicide. The accused sexual abuser was found dead in his Manhattan jail cell in August of 2019. That was about a month after he was arrested on federal charges. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Paul and Jess.
All right, Nancy, thank you so much. We appreciate it. Jess Metton and Paul Sweeney here in the Bloomberg Interactive Broker Studio. Remember a few weeks ago or a month or so ago, we had some bad smoke around here on the East Coast. It looks like the Midwest is getting slammed right now.
Wildfire smoke puts Chicago among the cities with the worst air quality in the world.
Wow.
Looking at this, and I mean, you had actually flown back from, I think it was Orlando. You were at a conference, and you had a pilot that was able to get you back here just in the nick of time. I had a lot of friends who were trying to come here that week that fortunately didn't make it because of that situation.
Yeah, so I mean, all across the Midwest, Chicago, some bad air, as well as Minneapolis, Detroit. They're in the top 10 with the worst air quality, all dealing with code red conditions. And air quality was even worse in smaller cities such as Grand Rapids, Michigan, where code purple has been reached, as it has in much of the central lower Michigan. So those fires in Canada continue to blaze, and the smoke is just extraordinary. And I thought it was just incredible a few years ago when we had smoke from the California fires, and it came all the way to the East Coast. You know, I just never heard of that before, but I guess as the fires maybe get bigger, more intense, more frequent, maybe it's just something that we're going to have to deal with to some degree.
In Quebec and Ontario in particular, so more than 3.7 million acres scorched over the last week in those provinces alone.
Yeah, so you don't really think about the forest fires on the eastern part of the continent, but there you go. So it's an issue not just for California and for some of the western states, but that issue is also coming east. So we'll keep an eye on that, of course. Looking at the markets here, a nice little rally. We'll take it for a Tuesday. S&P 500 up 0.9%. The NASDAQ, how about that, up 1.3%. That gets your attention. All right, Sound On with Joe Matthew and team. Sound On begins right now.
down $1.13 right now a barrel to 68.24. That's for WTI. So it really is having problems getting back up to 70 and holding that level. John, you're at the Collision Conference in Toronto, and you caught up with some executives, including the CTO of AT&T.
Yeah, we did, Matt. And look, right now we're watching technology stocks with this rip-roaring rally this year. And I got to tell you, among the 36,000 people who are here from more than 100 countries, you got thousands of startups. Everybody is talking about AI. So we see it in the market every day, but as industry gets together, they're focused on it as well. Let's hear a little bit more on what the Chief Technology Officer of AT&T, Jeremy Legg, has to say about AI being the real deal.
I actually think the rise of open source is going to be one of the more interesting things to watch over the next number of years, because you're going to have, all of the different communities around the world having access to that, whereas on the proprietary side, the access is going to be more limited to the companies that own that technology.
All right, so John is there at the Collision Conference. We'll continue to catch up with him. I want to bring you some breaking news right now. UBS is preparing to cut more than half of the Credit Suisse workforce that it bought. This starts next month as a result of that emergency takeover, forced takeover. Bankers, traders, and support staff in Credit Suisse's investment bank in London, in New York, and in some parts of Asia are expected to bear the brunt of these cuts, with almost all activities at risk, according to people familiar who talked to Bloomberg News. Let's get right over to Shonali Basak right now. She's got a little bit more detail here. And Shonali, we expected obviously some cuts to come, but now we're looking at half of Credit Suisse's workforce, more than half.
Yeah, I think the language there is very important. Half of Credit Suisse's workforce for the combined entity here, UBS, Credit Suisse, it's about 30% of the total, about 35,000 jobs, according to our colleagues reporting really from across the world. And remember, this is about a very significant reduction here of investment banking staff as well. Credit Suisse had a massive investment bank with a risk tolerance that was not quite the same at UBS. So it'll be interesting to see what the new combined entity seeks to do in the market. But it's very sensible that both in a downturn in the markets relative to a very big boom cycle, as well as a ton of overlap, Matt, and then you add in any attrition that you also might get on the heels of any potential overlap that there is when it comes to Credit Suisse and UBS staff, it's certainly a lot of jobs about to hit the market. Lastly, the way that this will be done, according to people familiar, is 3 rounds of job cuts this year, with the first round expected by the end of July and 2 more rounds tentatively planned for September and October. So certainly through October, through the end of the year, there will be kind of a lot of communication with staff, plus probably a lot of conversations across Wall Street and global finance.
So how will bankers have been prepared for this, Shonali? I mean, as I said, we knew there would be cuts, and I imagine most bankers at Credit Suisse have already dusted off their CVs and sent them off to headhunters.
Yeah, if I had to kind of explain to you what's going on underneath the surface, it certainly sounds like a flurry, doesn't it? You have conversations going on all over the place, but if you look across all of Wall Street, you do see marginal hiring, but you don't see hiring at full scale. We know that a lot of other banks are also laying people off in second or third rounds at this point. There's certain parts of the businesses there that will never come back in the force that it had the last couple of years. SPACs, for example. Credit Suisse is a huge SPAC banker. It's not that we've seen a ton of that activity or a lot of the bankers doing that anymore, but all I'm saying here is that some of the activities that we were very used to the last couple of years are not going to be the same things that banks are taking on in the future. So there will be a little bit of reinvention going on here as these traders and bankers look to find new jobs.
All right, Shonali, thanks very much. We'll be back with you in just a moment. I want to just look quickly at what's going on in terms of the markets right now, in terms of the share prices. UBS, for example, was up just a tiny bit in Swiss trading. UBSNSW is the ticker there, but of course the shares trade here in the U.S. as well. So I'll take a look at those shares. You can see they're up 1.6%. 1988, the level there. It's interesting, we have seen this forced takeover, and a lot of people have called it a gift to UBS in a sense, although they were reluctant to do it at first. Shonali, How does it look now, as if UBS got a deal with all the government guarantees they were offered alongside the price tag for Credit Suisse?
It does look like a deal. There were certain things that were very clear deals, those guarantees that they got that were very hotly contested. But there's something else to consider. It's the execution of this deal itself. There's a JP Morgan analysis of the worry about the erosion in the wealth assets. The Wall Street analysts, investors will have a very, very, very close eye on what happens to Credit Suisse's wealth business as it combines with UBS. So as we see these job cuts, and again, like I said, attrition on top of those job cuts, there's a wonder on what clients stay on board and what clients also start to move around the world as well. That's going to be this challenge for Sergio Armati and Colm Kelleher as this plan goes along. You're seeing shares up to the point because there will be a lot of synergies also. There's a ton of duplication. These are two major Swiss banks with a lot of similar businesses. They were fierce competitors. But with that said, some of this will help keep a handle on costs and gain scale for UBS so long as they can execute this and not lose too many key people along the way and key clients.
All right, Shonali, thanks very much. Shonali Basak there, Wall Street reporter, talking to us about this breaking news. Again, UBS is going to cut more than half of the Credit Suisse workforce. Our sources are telling us starting next month as a result of that emergency takeover. Remember, we're near the end of June, so this is coming pretty fast and furious. Let's get over to Allison Williams. She runs our bank coverage at Bloomberg Intelligence. And Allison, you run the coverage globally, so you're on top of this story and have been, even before it started developing. Was this much cost-cutting expected? Were we looking for more than half of Credit Suisse's staff to drop because of overlap?
I mean, certainly that is a big number. I think there's a few questions, right? So, the great Bloomberg reporting has said there's a memo, so that's probably a hard fact, and then there's also talks of how big the cuts will be. And so obviously 30% is a lot. I guess the questions are, how much of that headcount relates to business that had already sort of moved on to the non-core unit. So we know Credit Suisse had sold assets to Apollo. They had moved that into non-core. That was a significant chunk of business that we'd expect that that headcount would be reduced, and there's not going to be lost revenue associated with it. And then looking at the other businesses, that's really the question. Is the headcount sort of following business that they've already lost, from a market share perspective, or is this signs of further reductions in revenue to come?
How many bankers have left Credit Suisse already? I mean, surely they recognized the overlap. They must have, many of them, known their counterparts at UBS and already, as I was talking about with Shonali Basak, dusted off their resumes and sent them off to headhunters. What kind of, brain drain have we already seen at this bank, at the Target?
Yeah, so I mean, I might even say that those resumes probably didn't have a lot of dust on them, given what's happened in the Credit Suisse over the past few years. And so that's what we've been hearing anecdotally. And again, we've seen a lot of great reporting on this, that there has already been sort of a significant exodus. We've also heard on the wealth side of things, competitors are very aggressive there in terms of recruiting some of the business and a lot of the talk of the overlap. So that certainly may be a source of things. And then, it's a tough environment. So the other thing that we're seeing broadly across the industry, investment headcount coming down. And that headcount, I would say, is not a forward indicator so much as catching up to the significant decline we saw in investment banking revenues last year, down 50%. This year, there was hopes that we would get some kind of rebound. We're seeing things steadying at pre-pandemic levels, so really soft levels, really soft start to the year across all those businesses. So we're seeing headcount broadly, so that's also playing into some of the cuts that we're seeing here.
I wonder what the market is like right now, Allison, for bankers looking for a job out there, for those who already were or for those who will have to find one next month. Is it saturated?
So I think it is probably a very tough market out there because we have, as I said, we've seen sort of the revenue outlook come down dramatically. So 2021 was a record year. Things were cut in half last year, but things are steadying out really to levels that we saw before the pandemic. In fact, on one of the lower, I think one of the weakest years that we've had in sort of the last decade. And so I think it's tough and selective in those markets. By contrast, we are seeing, sort of signs of life in what I call adjacent industries, right? So we're seeing headlines around some of the payouts at hedge funds, pretty significant. So we'll see if some of the Wall Street talent finds its way over to that side of the business.
All right, Allison, thanks very much. Allison Williams there. She runs our banks coverage globally for Bloomberg Intelligence. Great to get some time with you. I'm going to go over right now to Zurich to talk a little bit more about this story. And I'll reset it for viewers just joining us now. UBS is preparing to cut more than half of the Credit Suisse workforce by starting next month. That's when those job cuts are expected to start happening. Marion Halftermeyer in Zurich wrote the story with Laura Benitez and Miriam Balazou, and she joins us now on the phone. Marion, what do we know, first of all, in terms of the numbers? I think the grand total of employees at UBS now, combined with Credit Suisse, is about 120,000, and some 45,000 come from Credit Suisse.
Exactly, that's correct. So we're looking at about 120,000 combined workforce, with 45,000 coming from Credit Suisse. They had already lost a number of bankers since the merger announcement in March. And overall, we were expecting big numbers. And so as we've learned, we're looking at an over about 30% cut of that total headcount, which equates to about 35,000 people. And with the bulk of that really coming from Credit Suisse staff, so the inherited staff that UBS has gotten now from Credit Suisse.
All right, Marion, thanks for checking in. I want to definitely touch base again with you and with Zurich as quickly as we can, but I want to get over right now to Tom Metcalf. He's joining us to talk a little bit more about this story, to weigh in on this story. UBS preparing to cut more than half of the Credit Suisse workforce, and we did expect cuts of about 30,000. I think those were the estimates. We now know that from people internally that they want to cut about 35,000. So a little bit more. Tom Metcalf joins us now to talk about what this means for the bank and what it means for the industry. So Tom, let's start with Sergio Armati. The chief executive officer has been brought back to UBS. He's making deep cost cuts to save, what, $6 billion?
Yeah, I mean, fantastic reporting here from Marion, and this is what Armati has kind of been signalling. The whole bank's been saying, look, $6 billion, just really in salary cuts alone. So what Marion's reporting is where most of those are coming from, as you might expect, from Credit Suisse, and it just goes to show yes, they've inherited this bank, but in certain areas they're really looking to sort of keep that pretty lean. So particularly the investment bank at Credit Suisse, that is likely to bear the brunt of many cuts.
All right, so Marion, what's the mood on the ground there in Zurich? I mean, I'm sure it's been pretty dark even since before this takeover was forced by the Swiss government. Does this make it even worse?
This does make it worse. It's been a long waiting game for a lot of these employees. I mean, it's been months of them looking for new jobs, trying to see where they would even fit in at UBS, because the businesses do have slight differences, and trying to suss out, who their direct competitors are and whose jobs they're competing for. So it's been a long waiting game, and now that these numbers are out and we published them, I think it'll cause a little bit more distress within the bank, because they're going to be waiting to see whether they're on those reduction lists, right?
Yeah, absolutely. In terms of other jobs, Marion, what else is there? I mean, I guess if you're looking for a job in banking and you've just been let go, or if you left Credit Suisse, or you've left UBS, there's nowhere to go but someplace outside of Switzerland?
So
So for investment banking, a lot of the key rainmakers, the ones that UBS actually would have wanted to retain, have actually been poached by competitors over the last couple of months. So we saw Santander really building up, Deutsche Bank took a few, Barclays. So there's not that many. The rest of the people that are there are going to be looking at places throughout the industry. Of course, a lot of banks are doing job cuts right now, so it's not an easy environment. On the wealth side, it's a little bit of a different story because everybody, Citi, JP Morgan of the world, they are interested in building up their wealth businesses. So they might be looking more to poach talent. And then you have the local private banks that are expanding and want to, potentially take on the wealth bankers. But that's an area that UBS is not necessarily going to be cutting first. They're really focusing on the IB, the markets, the traders, with that also the support staff for those teams. And then they'll eventually move on to other parts of the businesses and corporate functions where there's much more overlap.
All right, Marion Halftermeyer on the ground there in Zurich. She broke this UBS news. Tom, what's your take on the market for bankers? Because, of course, anyone tuning in right now who has either left a bank or is planning on leaving or will be let go, as it looks like maybe 35,000 will be from Credit Suisse starting next month, they're going to want to know what's the market. How saturated is it? Where can their resumes be sent, or do they need to look for a different industry?
Yeah, and sitting here in London, where you're going to expect a lot of these cuts to be made, over in Canary Wharf, it really comes down to what are the areas. In some cases, it's just not a good fit for UBS, for instance. That's just a tough market to go into, and it's definitely a buyer's market, as it were, right? You're going to have thousands more people sort of on the streets looking for jobs, and whether they can, fill all those roles seems unlikely, particularly, in that deal-making space where, yes, the top performers absolutely high in demand, but if you're more of the rank and file, we're seeing cuts at other banks as well, right? Goldman, Morgan Stanley cutting thousands of jobs. So very difficult times are in that space, and that's the irony. The ones where there's probably lots of demand is probably the areas where UBS are also trying to keep hold of those people.
All right, Tom, thanks very much. Tom Metcalf talking to us about this news. Let's get back to Marion Halftermeyer in Zurich. She broke the story and put it out. Sorry, Marion's dropped the line. So I'll just reset the story for you. UBS is preparing to cut more than half of its Credit Suisse workforce starting next month, according to sources. Now, UBS in total has 120,000 employees. The Credit Suisse portion of the bank, since the forced takeover, has about 45,000. And sources inside the bank tell us that 35,000 of those jobs could go starting next month. So let's take a quick look at what's going on in markets right now. We have had a rally that continues. You can see UBS shares are rising. These are the U.S. ADRs. Of course, they trade mainly in Zurich. If you take a look at the broader market, it looks like the S&P has gone back into rally mode. Now up 1.1% at 43.76. We're still not at that big round 4,400 number that we topped last week, but we at least snapped a two-day losing streak. You can see the NASDAQ here climbing 1.6% as it's really tech stocks that are bringing us back. And in terms of what we see going on in fixed income, we do see investors selling bonds to some extent and yields rising pretty much no matter where you look across the curve. There's the 2-year, if you like. Typically, we would look at the benchmark 10-year. And if you do look at the 10-year, right now we're looking at a yield of 3.76. Let's bring in Marilyn Watson. She's head of global fundamental fixed income strategy over at BlackRock to talk about this market. And Marilyn, I guess it's still all about the Fed, really, isn't it? It's still all about that debate. Are they done raising rates? Are they going to raise one more time in July? Or might they even go up twice again as the dot plot signified? What do you think?
Good afternoon. Well, certainly, I think in the bond market, it is still a lot about the central banks, not just the Fed, but the Fed in particular, as we look to July. At the moment, the market is pretty much pricing in another 25 basis point hike in July. And then from there, obviously, we saw the Fed's own summary of economic projections were actually increased by 50 basis points in total by the end of the year. I do think now it is very, very data dependent. When you look at the U.S. economy, it does remain very resilient again, we've had more very strong data out of the housing market today. We've had further strong confidence data out as well. The labour market remains very robust. We'll see the initial claims coming out on Thursday. We'll also see the PCE deflator in terms of inflation coming out on Friday. And then we do have two other big key data points coming out before the Fed meet again in July in terms of the payrolls report and also the inflation report. So there's a lot of information to come, a lot of data to be seen. But I think at this point, the U.S. economy overall does look to be incredibly resilient in light of the very aggressive hiking that we've already seen from the Fed.
Marilyn, you are the head of global fundamental fixed income strategy. Are there other markets that you think are more interesting right now than the U.S.?
There are some very interesting markets at the moment. So when we look globally, certainly the Eurozone is interesting at the moment, given how hawkish the ECB are. And, the Eurozone economy does remain on relatively good footing, but inflation isn't coming down as much as they would like. They've actually even increased their own forecasts for core inflation, which is tricky. And then we've had some lackluster data out of the Eurozone in terms of PMIs and the overall economies. So the Eurozone is interesting, and we actually do like some of the dispersion that we've seen, particularly in the corporate bond space, where we're seeing a lot of difference now between different bond issuers in terms of the price and performance there. So I think on an active basis, then we really like some relative value trades. We also like emerging markets now. So we like, for example, Brazil, Mexico, where we do think, again, that now those central banks were on the front foot in terms of trying to fight inflation, and now it looks like they will, probably start cutting at some point soon. So looking around the globe, I think there is a lot more opportunities, and we are seeing a lot of more differentiated markets and dispersion. And I think if you can, be nimble and be active, then now is actually a really great time to be in the bond market.
All right, Marilyn, thanks very much. Marilyn Watson there joining us from BlackRock to talk quickly about fixed income to us. Let's move now to equities and to our stock of the hour. The Hartford is a national leader in property and casualty insurance and is expecting a busy hurricane season as the NOAA predicts an above normal storm season. Now the company is leveraging AI to expedite claims and help customers recover. Let's bring in Chris Swift, Chairman and CEO of the insurance group, The Hartford. Also joining us is Shonali Bassick to talk with them. So Chris and Shonali, welcome to the program. Thanks very much for joining us. Let me start by asking you about AI, Chris. I am less surprised now to see about the use of AI in other industries because I continually learn about the new ways it can help us. How will it help you at The Hartford?
Well, first, Matt and Shonali, it's great to be with you, and thank you for inviting me on your program. We think AI, it can be a game changer in a number of aspects of our business. But I would point out that we've been using machine learning, AI-orientated processes, particularly in claims, particularly in certain aspects of underwriting. Think of imagery and pictures. So we've trained machines to read pictures of buildings, structures, roofs, and this will be the next phase of machines ultimately helping augment our human talent to be more timely and more accurate in everything we do.
There's AI that is experiencing somewhat of a rate of change here, Chris, but then you also have a lot of questions in the market about weather itself and climate here as well. When you're looking at kind of this season, how are you preparing for it, and is it better or worse than what you've seen in the past?
Well, our preparation begins with our agents and customers when we underwrite a policy for the next year. And we take an opportunity to look at risk profiles, whether it be roofs, windows, building codes, and really try to offer advice to our customers through our valued agents and brokers on what people could do to mitigate risk. In other words, lower the risk of damage. From there, we really then turn it over to where storms are going to form and where their tracks are. And we have very sophisticated tools and technology that will overlay a projected storm path with all our houses or homes, or as we call it, PIF count, policies in force, so that then we could send out additional communications to agents and brokers along with our customers directly of cautionary things they can and should do. And then lastly, it's the recovery phase. You know, when an event happens and there's damage, there's displacement. We have something we call our catastrophe van, which is approximately 60-foot vehicle that is on premise to act as a remote claim office, dispense cash if people need it, food, water. And, you know, as I always said, Shonali, we're in the business of paying claims. People give us money to be able to respond during, you know, these times, and we take that responsibility very seriously. And we want to get people back to normal as quick as possible.
All right, Chris, in terms of the hurricane season, the coming hurricane season that NOAA has predicted will be worse than anticipated, how does that affect your business at the Hartford?
Well, you know, Matt, you know, predictions sometimes don't come true. So, you know, NOAA is projecting, I would say, slightly above historical 10-year averages, both formation and severity. And it always depends on where, you know, storm is going to hit. And part of where it hits, also we have to deal with wind shear. So we're in an El Nino year right now, which means more formation. But the counterbalance is,
Chris, unfortunately, I'm going to have to jump in here because of a computer. We have a hard break, but I really appreciate you joining us. Chris Swift there from the Hartford. I thank you also to Shonali Bassick for joining us on set. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Only on Bloomberg TV and radio.
Welcome back to Bloomberg Markets to Close. Kicking you off to the close of U.S. trading, but we start the show today overseas in Europe. The combination of UBS and Credit Suisse, we knew that it was going to result in job losses. Now we're learning about the magnitude of those losses. UBS said to be planning to cut about half of the workforce that it absorbed from Credit Suisse starting next month. This as a result of that bank's emergency takeover. Marianne Halftermeyer is our reporter on the ground over there in Europe, joining us by phone here. And Marianne, let's start off here. When we talk about half the workforce of Credit Suisse, put that into perspective. How many jobs are we talking about?
So we're talking about more than half, actually. And in combined workforce, after UBS and Credit Suisse officially merged earlier this month, they were looking at about 120,000 employees. When we're talking about more than half of Credit Suisse employees, we're talking about more than 45,000 employees. So that's somewhere around the 20,000 range for employees just from Credit Suisse. Now, overall, the bank is looking to cut about 35,000 or 30% of the grand total.
So give us some sense here as to, A, how long this is going to take, and are the cuts that they're making, are they strategic in nature, or is this just kind of across the board?
So we're expecting the job cuts to start in July, and then 3 rounds of job cuts officially happening this year, a couple more happening in the fall. In terms of where the cuts are happening, they have expressed repeatedly that they plan to downsize dramatically the investment bank. From what we understand, the investment bank, the traders, the support staff for those teams are really going to be bearing the brunt of the cuts. And then they'll be moving on to areas of overlapping corporate functions. The one area that is expected to be saved from any dramatic cuts would be the wealth management division, which is a key business for UBS and one where they really want to grow. So they are really looking to retain as many private bankers and bankers to the rich and wealthy of the world.
Anytime you get these types of job cuts announcement, and even before the announcement, we knew this was coming, Marion. If you are a high performer, if you will, at one of these banks, whether on the UBS side or the Credit Suisse side, you might have options out there. And I am curious if there is some concern here that they could actually lose, I guess, some of those high performers, competitors.
That has been happening. They have been losing high performers even before the merger was announced in March. Credit Suisse had been losing a lot of high performers due to its losses and scandals and people being poached. But since then, they've lost a lot more bankers, particularly the key rainmakers in the investment banking. You think about like the technology sector, which is really hot. Those bankers have been poached already. And this now, unless those bankers have been taken care of and UBS has given them proper retention incentives, such as bonuses or guaranteed payments, they're likely going to be looking for the exit doors faster than they can be laid off.
And give us some sense here. I mean, we know that this was effectively a government broker deal. I assume the government over there is okay with what they're doing next, right?
So typically in all of the countries that they operate in, they will have to some extent coordinate with the government to do these mass layoff plans. In Switzerland, it's a very sort of political and detailed process where they have to do these sort of plans to enable people to allow them to find other jobs or reapply for existing openings. So there is probably in each jurisdiction the support that they needed for these plans.
All right, Marianne Halftermeyer there out in Zurich here. The headline crossing the wire just a little while ago involving UBS and Credit Suisse. UBS preparing to cut more than half of the workforce that it absorbed in that merger with Credit Suisse. We're going to try to get some more details on that, and we will return to that story at some point here in the afternoon. Meanwhile, we do pivot back to U.S. markets, which actually are having a pretty good day here. Remember, it's been 6 straight days where we've kind of been in the doldrums here, but now some optimism out there. Strong U.S. home sales data, strong consumer confidence data may be providing a little bit of confidence here for U.S. equity markets. Drew Mattis joining us right now, MetLife Investment Management Chief Market Strategist. And Drew, I do want to get your thoughts here on how much some of these economic data points, how much the macro is still driving market sentiment.
Oh, well, I think it's driving it today, obviously. We had some very strong data, unsurprisingly strong data, in my opinion. And what do you have? You have the yield curve inverting further. I think it suggests that people believe the Fed's going to have to move a little more aggressively. And when they move a little bit more aggressively, they're going to be moving more aggressively in order to break something. And so I think that's why the curve's behaving the way it is. And I think that's the takeaway.
Oh, well, what do you make then of the economic data points? Because when you look at what the curve is pricing in and maybe pricing in a somewhat less optimistic scenario than what we're seeing in the equity market here, but a lot of folks are looking longer term. They're looking into 2024 and beyond, and they still seem to find some degree of support for current valuations.
I think the equity market and the fixed income market are just looking at two different time zones, quite frankly. The equity market's looking at, oh, the data's good, the economy's fine, and they're responding to that. And the fixed income market is saying the data's good, the Fed's going to respond to that, and that'll mean it won't be fine later. When I look at the data, though, what I'm really focused on going forward is simply, what does inflation look like at the end of the week, and what does unemployment do the week after? I think from those two variables, you'll be able to tell what the Fed's going to do, and you'll be able to tell kind of the risk of recession going forward.
Yeah, of course, we still have to wait about another week and a half before we get that latest jobs report, and then about a week and a half after that, Drew, we do get the next Fed meeting. Basically, you have a market right now that is priced back in the prospects for a 25 basis point hike at the next meeting here. Do you anticipate we'll get more after that?
We're not anticipating you'll get that rate hike at the end of the month. I think when you get the unemployment rate data, I think there'll be another tick up in unemployment. And I think the inflation numbers will show some moderation, enough moderation to cover the Fed in terms of not having to move forward with additional rate hikes. I think if they were confident they could hike rates at the last meeting, or that they're going to hike rates going forward after they skip the last meeting, they would have just done it at the last meeting. So they don't know. They really are data dependent. And I think the data is going to suggest to them that, taking another month off might not be the worst idea.
And give us some sense here as how you position around this market, Drew. If you believe in some of the things that we just talked about with regards to the Fed hikes as well as economic conditions here, what is the allocation, if any, that's different now than maybe a year ago?
Well, I think what you should be doing now is looking for, what you would want to buy when the pricing evolves in a way that you would like. So, do you think risk assets are a good idea right now? I think if you're heading into a recession, risk assets are probably not where you want to be right now. But you certainly want to be looking for which assets you would like to add as we head into a recession, because as spreads widen and pricing adjusts, there'll probably be some good bargains out there for some assets that are actually, maybe disproportionately affected by the fear of recession rather than something that might actually be impacted by the recession. So you want to be identifying the assets you want now so that when the time comes to buy, which we think is coming soon, you'll be prepared to make those decisions quickly because the opportunity might be fleeting.
How much we hear so much discussion, Drew, about this sort of dry powder on the sidelines, whether it's from individual investors or institutional investors. Do you think that money, do you actually buy into that theory about the cash on the sidelines? And if so, do you think that money will come back into the market in mass, should we get a little bit more of a green light?
So I do buy that theory. I think, it's been a long time since we've seen cash yielding, 4 or 5%. So, the dynamics then around the market become quite different. And so it's been years since we've seen that. And it's very difficult for people to kind of adjust from a 0% rate environment where any kind of move higher in yield for any asset was kind of a reason to move back in. So I do think people will move back in, but I do think it takes more for those people to move back in than it has in recent times.
All right, Drew, great to catch up with you. Drew Mattis there. He's the Chief Market Strategist over at MetLife Investment Management, helping us kick you off to the close here on this Tuesday afternoon. We started the day this morning on the U.S. side with data on new home sales. It surged, purchases rising at the fastest pace in more than a year. We're going to discuss those numbers with Danielle Hale over at Realtor.com. Plus, China's central bank stepping up support for the slumping currency. More on the mounting investor pessimism towards the world's second largest economy. And Christine Lagarde kicking off the annual ECB forum in Portugal with, well, a hawkish tone. We're going to have highlights from that retreat. All that and more coming up in a bit. This is Bloomberg.
everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. The moment news breaks, no one covers the world like Bloomberg.
The image of Vladimir Putin as the all-powerful leader has been rattled already. History was made here at the federal courthouse in Miami when Donald Trump became the first ever former president to ever be arraigned on federal charges.
We're going to need a new engine technology, and that's where the real battle lies. And whoever makes that decision first is going to have a huge impact on this industry.
Bloomberg, your global business authority.
We need to bring rates into sufficiently restrictive territory to lock in our policy tightening. We need to communicate clearly that we will stay at those levels for as long as necessary. And this will ensure that hiking rates does not elicit expectations of a too rapid policy reversal and will allow the full impact of our past actions to materialize.
The president of the European Central Bank there, Christine Lagarde, kicking off the ECB's annual forum over there in Portugal with a hawkish tone there, declaring the central bank has more room to run. Let's bring in Bloomberg International Economics and Policy correspondent Michael McKee, and I guess that's not surprising when you look at the inflation rates over there.
Not just there, but elsewhere around the world. You know, the Major League Baseball All-Star Game isn't for a couple of weeks yet. If you collect central banker trading cards, have we got an All-Star Game for you? Tomorrow, we get a panel discussion with Christine Lagarde, Jay Powell of the Fed, Kazuo Ueda of the Bank of Japan, and Andrew Bailey of the Bank of England. And they're all going to be discussing the same thing, what to do about inflation, although Ueda-san has a little bit different situation. All the others are looking at the progress that they have made on inflation, bringing it down. And while they have made some, expect them all to be talking, as Madame Lagarde did today, suggesting they have much more to do and they will be higher for longer. The Japanese are seeing inflation rise, which is something they've been trying to get at for several decades. So Ueda is more likely to talk about staying the course. There's been some idea that they would start to raise rates and get away from their zero bound and their monetary policy, unusual monetary policy. But at this point, it looks like, Romaine, that they're probably going to stay the course while the others are going to talk about keep watching for higher rates.
Oh, okay, just to be clear, you don't actually have a set of central banker trading cards, do you?
I don't.
Okay,
but if somebody wants to invent them,
I have a feeling they're probably out there somewhere on the internet. In all seriousness, though, who else are we expected to hear from at this forum? And do you expect to hear, I guess, as pointed of a statement as we got out of Lagarde earlier today?
Basically, we've been hearing from other members of the European Central Bank, and their message has been the same. They seem somewhat unified. However, there is a question about how far they can take this, because when you look at what the inflation rates are in these countries, Spain is expected to go below 2% on Friday, and the Eurozone is expected to come down. It's countries like Germany still over 7% that are the problem. So will there be some division among the members of these various central banks? We've already seen it at at the Fed.
Yeah.
Do we get more of that from the ECB?
It'll be interesting to see here. Of course, looking at some of those inflation numbers, I guess sans Japan, you get a sense here of some of the hawkish commentary. Bloomberg International Economics and Policy Editor Michael McKee there. Let's keep the conversation going and go over to Asia, to China specifically, with the central bank there pushing back against some of the investor pessimism, stepping up support for the yuan, which has been slumping, by setting the daily reference rate far stronger than estimates. Tom Orlick joining us right now. He is our chief economist at Bloomberg Economics here. I think everyone was looking for some degree of support, Tom, when it came to shoring up the currency. This was a little bit stronger, though, than what the market had priced in.
Yeah, I think that's right, Romain. Now, I think the PBOC is a little bit conflicted on this. On the one hand, with domestic demand really weak, remember